raise interest rates in Q4 and do the same thing again in Q3 23. Whenever you get a big change like this, and this is regime change for the ECB, for people who have covered this central bank, it has been 10 years, Tom, since we've had a serious conversation about raising interest rates at the ECB. The last hike, Trichet, July 2011. It has been a long, long time. So you have to price in something as opposed to nothing and then work out what the something is. And Tom, when we work out what the something is, I do wonder how far they can push this, because before they're doing anything, we're seeing some big moves in this debt market.
Well, we'll have to see. Right now, we're going to do something which is recalibrate off of Friday's stunning jobs report. Ian Shepherdson and I are on the same page, chief economist at Pantheon Macroeconomics. And Ian, more than any other time in my life, I am saying we will anticipate in early March the February wages report. I mean, that's really what this has come down to, is the non-countability of two jobs series, but the real countability of surging wages. How do you study wages 30 days from now?
Yeah, the wage numbers Friday were a really big surprise. I mean, all the attention went on the payroll number because there was a big beat and there was big upward revisions. But there was also big upward revisions to hourly earnings. And so now the data show that in the 3 months to January, the annualized rate of increase was 7.7% compared to the previous 3 months. Now, that is a lot stronger than anybody was looking for. It just got lost in the noise of the payroll report. So now the question is, well, what happens February, March? Because I can promise you that if we see that sort of growth rate sustained, the Fed is going to be extremely unhappy, because there's just nowhere in the world that they can possibly imagine productivity growth would be high enough to offset wage growth at that sort of pace, and therefore it's a direct inflation threat down the line. Even when the supply chain pressures have disappeared, even when all the chips are back online, you know, even if oil prices level off or come back down again, if wage growth is running at 7.7%, they're going to be raising rates until it stops. There's no question about that.
Which wage series is most informative for our listeners and our viewers?
You've got to be patient for that one, I'm afraid. You know, we get the hourly earnings numbers every month, but it's a very crude number. There's no mix adjustment either within industries or across industries. It's just a crude average. The clue's in the name. But the employment cost index, which comes out once a quarter, is much more reliable because it adjusts for all of these mix effects. And the last number, and this is one of the reasons why the hourly earnings report was so startling, because the last ECI report for December was relatively friendly. It showed wage growth at annualized 5%, and then we print hourly earnings at annualized 7.7 for the last 3 months. So the pressure now on that next ECI, which will be released just before the May FOMC meeting, is enormous. Because if it turns out that the hourly earnings surge is some sort of statistical fluke connected with the poor quality of those data, and the ECI remains calm, then the Fed's in a much better position. But if the ECI print matches the hourly earnings numbers, then heaven help us, because interest rate expectations, which have, of course, shot up over the last couple of weeks, will rise further, and people will start to talk about a much longer tightening cycle as well. All the focus right now is, you know, how many hikes in 2022.
Yeah.
But if we're really on the verge of sustained wage inflation, it's going to be how many in 23, and what happens in 24. It's a game changer.
Ian, can we talk about how reliable some of this data is? I know how much work goes into it, but I think a lot of economists have been whipsawed by it, including you. I remember a few payrolls reports ago when you had a pretty big number, and we got a downside surprise, Ian, and you were sitting there thinking, this doesn't make sense. And then we got the revisions, and Ian, it started to make sense. And I wonder if we'd had those revisions before, if this Fed would be in a different place.
Yeah. Well, for sure, you know, I think if we'd had the wages numbers that we've had and we'd had the payroll numbers that we've just had, I think maybe the talk would have been a lot more hawkish than it already has been. So I'm very intrigued to see what Fed officials say over the next couple of weeks, because they'll be digesting those numbers and saying, well, you know, hang on a minute, we weren't really banking on this. It's become a really big problem. You know, I'm a huge fan of the statisticians at the BLS. I think they do an amazing job in very difficult circumstances. I am not going to get into the, you know, let's bash the officials, the data are fake, all of that nonsense. They're really hamstrung by the difficulty in getting survey response rates up as high as they used to be, and also because the seasonal patterns have gone haywire during the pandemic. So they do have a really difficult job. I do think, however, there's a case to be made for maybe delaying the release of some of these reports, especially the payroll numbers, until they've got a bit more of the raw information in. So that would reduce the revisions if they just wait a little bit until they can process some more data, get some late returns in from employers, we'd be kicking our heels for a couple of weeks longer, but we'd be getting better quality data out of it. It's a really big problem right now because you get these prints and you kind of shrug your shoulders and say, okay, well, that's what it says now, but what are these same numbers going to look like in a month's time? It's a pretty good bet that they won't look the same. So we're all in the dark, but the numbers come out, the market reacts, we can't ignore them, even if we think they're probably not very reliable.
And so the data is confusing, but so too is the momentum in the U.S. economy. And I ask this to understand whether it can withstand 5 interest rate hikes this year, as the market is currently pricing in, at the same time that a tightening cycle is beginning in the likes of the European region as well as the U.K.
Sure, we're in a rising rate environment everywhere. Real rates are too low everywhere. They have to, balance sheets have to shrink eventually at some point in central banks. So we're definitely moving into what I think will be an extended tightening cycle. Now, kind of from a stepping back and looking with a bird's eye view, I'm quite happy about this because it means that economies are normalizing, and a rising, sustained rising real rate environment is a signal of normalization. It's a good thing. But of course, for markets, it's a dislocation, and we're being whipsawed by the speed of these movements and the changing language from central banks everywhere, and their actions as well. So it's a difficult environment, and it's just not going to get any easier for the foreseeable future. The thing that I think is different between the previous sort of short tightenings that we've seen in the last few years before COVID is that the private sector is in much better shape. Both households and corporations in the US are sitting on massive piles of cash that they didn't have the last time the Fed was tightening. The debt service ratios are extremely low, kind of the lowest we've seen going back decades, and that means that their ability to absorb higher interest rates probably is a bit better than a lot of people think. So I'm certainly not in the camp that says, a couple of hikes and the economy will fall over. Markets are different, though, and the thing that the Fed has to juggle is they might not be doing damage to the real economy immediately, but if they over-tighten or they scare markets and we end up with a really big correction, that feeds back potentially into the real economy and complicates their situation. So I got to say, I don't envy them, but I'm pretty sure that they're going to be tightening for the first 2 or 3 hikes are pretty much a done deal now. After that, everything is contingent on the market response and the real economic response, and they're, I think, pretty murky at this point.
It's the after that we need to spend a ton more time talking about. Ian, great to catch up. Ian Shepherdson of Pantheon Macroeconomics. We've got a little bit of a combination here, Tom, between Frontier Airlines and Spirit.
Yeah, this is a Bill Frank deal. Bill Frank is legendary, John, in low-cost airlines, including all the way down in South America. He's chairman of the board of Frontier. And with Indigo Partners, he's doing this mating. I don't have in front of me, John, the overlap of Frontier associated out west, Denver, and Spirit down in Florida. But I'd like to believe the overlap's not that great, and that's a synergy. What's important, John, is right at the top of the press release, they go after the hot button, the third rail, if you will, for politicians in Washington, which is their presumed service of mid-sized and small cities. That's the huge issue that will affect this transaction.
Elisa, the implied value, $25.83 per share. Spirit trading in the pre-market at $24.50.
All right, can we just play a guessing game? Who do you think among the 3 of us has actually flown either Frontier or Spirit or both of them?
I'd only thought that when the headline dropped, and without a doubt, it's you.
That would be me. It would not be either of you.
Are you about to give us a review?
Well, look, I just know that my son hates when we go on Frontier because he says that we have to buy the Coke rather than get it for free, and he knows that I won't do it. So, look, honestly, there is an issue of real budget airlines and the future of them, especially at a time when you do have the larger airlines raising prices. So there is a niche here, how they get a foothold, whether it is that critical mass that's crucial to overcome some of the supply chain and labor issues.
Hang on a minute, I'm distracted now.
Oh, I'm sure you are.
You don't buy the boys a drink on the plane?
I will, but I use it as leverage to make sure it goes smoothly. I can't believe that I'm really confessing my parenting.
You use hydration as leverage.
It's not hydration, it's Coke. I'll get them water.
They can have water.
Yeah,
it's
sure.
Good to know.
Coke isn't hydration.
It is tough for the Bramo household.
Come on, you try
Seriously.
raising boys. Come on.
I'll take your pass, Lisa. Futures down 7 on the S&P.
Frontier from Fargo to Bismarck.
Good morning, lads.
Done that.
I'll give you some money for a drink next time.
Oh my God, don't watch this.
The Nasdaq down 0.1%. From New York, this is Bloomberg.
With With the First Word News, I'm Ritika Gupta. This week, data are expected to show that inflationary pressures in the US kept heating up at the start of the year. That will probably put a Federal Reserve interest rate increase next month on autopilot. According to a Bloomberg survey, the Consumer Price Index likely jumped 7.3% in January from a year ago. A member of the European Central Bank's Governing Council sees an interest rate hike as early as October. Klaas Knot told Dutch TV that a 25 basis point increase is likely. Knot said a second rate hike can then take place in the spring of 2023. He is considered one of the ECB's most hawkish officials. The pandemic and China's restrictions to control it are still damaging domestic spending. Travel and consumption during the just-ended Lunar New Year break was down from 2021's already low level. People in China made 251 million trips during the 7-day holiday. That's down 2% from last year and a 26% drop from 2019. And in Hong Kong, the number of coronavirus infections is now doubling every 3 days. The city reported a record of more than 600 cases. That puts pressure on the government to ramp up restrictions as it tries to eliminate the virus. And the CEO of Spotify has apologized to staff for the controversy over Joe Rogan's podcast, but Daniel Ek says he doesn't agree with the calls to drop Rogan from the streaming service. Rogan is under fire for making racial slurs and spreading COVID misinformation. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We're different in the U.S. You know, we knew there was going to be a lag. We knew there were going to be this hospitalization wave. We knew there was going to be this loss of life. And we still don't have high enough immunization rates, and we still don't have high enough boosters, particularly for people over age 65. So that's a big part of the reason why we're not there yet.
Chris Barrow there, the epidemiologist and professor at Johns Hopkins Bloomberg School of Public Health. With Tom Keene and Lisa Bramberts, I'm Jonathan Ferro. Your price action down 0.2% on the S&P, down 0.1% on the NASDAQ. Often we get people reaching out saying, just use it, use the H word, hyperinflation. Can I just remind you of where Zimbabwe is right now? The central bank, Tom, just maintained its key interest rate unchanged at what? At 60%. Let's please not use the H word, Tom, when it does not apply. That world is a different world.
Yeah, that's been true for decades and ever more so now. And, you know, there's some fancy mathematics involved here, which we don't do on Monday. But the answer is, you're right, John. It's overused, and you're correct to call on it right now. Let's go to the pandemic and get an update here. Certainly good news for America. Joshua Sharfstein joins us, Vice Dean of the Johns Hopkins Bloomberg School of Public Health. Of course, Mr. Bloomberg with an acquaintance with his TV and radio network as well. Dr. Sharfstein, we're beginning to see politicians act. John Farrell brought up on Friday or Thursday the positivity rate. Can we have a rule-based or single rule system to unwind our policies on the pandemic wrapped around a ratio like a positivity rate?
Well, I think positivity rate is important, but it's probably not enough because it depends a lot on the number of tests and who's getting tested, and a lot of tests aren't getting reported. But the concept that you're bringing up, having an approach to unwind, I think we're seeing that happen in different places organically, but the key metrics for me would be around the number of COVID-related hospitalizations. That'd probably be number one, and potentially cases number two. But I do think that there's room to move, and I think we are going to see over the next couple months that it's going to be okay to slowly back down on certain measures that we've been living with. 2022 is different than 2021, but it doesn't mean we're in 2019.
It hasn't happened yet, but I'm going to ask the question I believe I've asked every single day for the last week. Cases roll over. You mentioned the good news, hospitalizations roll over. Do you just presume deaths will roll over?
Yep, I do think that's going to happen. It's just a terribly tragic moment still because so many people are losing their lives. And it's a reminder of how much is at stake and how we can't just, forget about the pandemic. But yes, that is what's going to happen. I don't know if you remember at the beginning or in December when we were talking about this, we saw the curves in South Africa and we said, we're going to get a similarly shaped curve in the United States. And that's what we've been getting. It's just now we're on to that second phase. And on the other side of the Omicron curve, we've got, important work to do.
Dr. Sharfstein, how difficult is it for you as a public health official to keep talking about remaining vigilant, having caution, staying away from people, not necessarily going to the same sorts of pre-pandemic activities at a time when there is a primal cry going up in the likes of Ottawa, where there are protests about additional lockdowns, where you have children that are dealing with the scars of what happened, when people are saying we can't keep going with this, and you're seeing sort of other health issues spring up that are consequences of the social distancing era?
Well, I think part of the message isn't just, stay away, stay away, stay away. Part of the message is do more, find your place of risk tolerance and, do more. And depending on the person I'm talking to, generally they're pretty happy that I'm saying it's okay to do things. So I don't really feel like I'm coming in with a doom and gloom message. I do think that the vast majority of people want to be cautious and do not want to go racing into, a huge cloud of COVID. And so while there are some people who are, quite upset and obviously they should be listened to, but, certain point, the society gets to decide how to protect itself. I do think that overall, it's not that hard.
Okay, so going forward, you do think that it's important for people to loosen up. Do you think that this world has gotten so polarized with respect to those who are cautious and those who think that it's all bupkis, basically coming out and saying, look, you got to take a middle ground, you have to move on, that it's incredibly difficult to do that?
It is very difficult because I'm worried, and I've done some podcast interviews with people, and we've talked about this, that you find a good middle ground, you find those thresholds, you take a step as a society and policy, and nobody is happy with it because half the people think it's too far and half the people think it's not far enough. And so it really emphasizes how important it is for public officials, for public health officials to be explaining relentlessly, trying to get as much social understanding of the policies that are getting put into place. It's been really hard. People are dug in, but there's just no alternative. And the more people who understand the basis for a decision, the better off you are. But I do agree that there's a big risk. You'll have people on both sides who feel betrayed, frankly.
Doctor, just quickly, I just want you to speak to something a little bit more clearly. So many people have been talking about this report, this work that came out of Johns Hopkins, that lockdowns did not work. That wasn't affiliated with your school, the School of Public Health. Can you walk me through the conclusions of that, the questions you have about it?
Sure. Well, that was a working paper that one of the authors was affiliated with Johns Hopkins, not the School of Public Health. It's not peer-reviewed. Its conclusion purported to be that lockdowns don't really affect mortality much, but to reach that conclusion, they created their own definition of lockdown. And they picked and choose which studies that they were going to include. And it's a reason why studies like that really do need to be peer-reviewed. It doesn't present new data, and it doesn't change any of the basics that we know, which is that the coronavirus is a respiratory virus. It transmits between people. The more contact between people, the more transmission, the more hospitalizations, and the more deaths. And early on in the pandemic, stay-at-home policies were necessary to prevent, the transmission of a serious virus that we didn't know a lot about. But fortunately, we have other tools now, and those include, vaccines, tests, masks. And because of that, we don't have to resort to stay-at-home policies.
Doctor, as always, we appreciate your time. Joshua Sharfstein there of the Johns Hopkins Bloomberg School of Public Health. Tom, the world's moving on. Australia is moving on too, opening up to double-vaccinated tourists from February 21st. There we are, TK.
Yeah, New Zealand, and then we have Australia. And also, I just noticed in one of the papers, the governor of New Jersey really looking at getting away from masks in schools. I think there's a lot of, as Dr. Sharfstein says, John, it's all going to be on a micro basis. And you wonder, our own selfish interest, you wonder what it means for New York State and New York City.
Qantas Airways trading in Australia, Lisa, that stock up by 5% today, 4.6% at the close.
And the one outlier amid all of this and the reopening and the zero COVID tolerance that has failed in Singapore, has failed in Australia, China. I do wonder, with the focus on the Olympics, with the focus on the quarantining segments, when do we say, okay, we're done? Can they get there, given that there is not that herd immunity or that base of immunity that other nations have?
John, I think Australia is just simply celebrating after what they did in curling over the weekend with Dean Hewitt and Tolly Gill from Victoria. They're not from Perth. There's no curling in Perth.
You watched.
But
you're watching the curling over the weekend.
Really?
Yeah, well, you got to get
not
behind
that bad.
Australia at the Winter Olympics.
TK, Tom Keane, Lisa
domestic
Bramett,
and curling.
Jonathan Ferro. Futures down to 10.
Then they go like
on the
this.
NASDAQ, on the S&P. I wish we could repeat
Lots of
that.
screaming.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We absolutely think that this is the year of the stock picker.
You have to look for those companies with sustainable growth and market opportunities.
I would want to make a distinction between, unprofitable tech companies and other growth areas of the market that are profitable.
I think the frothier areas of the market will continue to have headwinds.
I think we have to all sort of fasten our seatbelts. It's going to be a volatile ride.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
I'm just here for another hour to see Tom's impression of someone curling at the Olympics again.
Oh,
can we do that again?
Never done it.
Clearly, Tom Keene, Lisa Abramowitz, and Jonathan Farrow.
Oh my God, that's really disturbing.
That's petrifying, TK. Futures down a tenth on the S&P. I'll move on, Lisa, for you.
Please do.
We're negative on the NASDAQ 100 too. Lisa, those bond yields in Italy.
Look at those bond yields in Italy. Honestly, the question really of the morning is how far will the ECB allow those yields to go up in addition to what those hand movements were that Tom was just doing? But honestly, where is the put here of the central banks as you do see yields move pretty violently upward?
Tom, this is a big move. Let's sit on it for a while. Up 13 basis points on twos in Italy, up 13 on tens. This is a breakout, and it adds to a major move from last week.
There's a real mystery here. I go back to Marvin Goodfriend, the late Marvin Goodfriend's paper, controversial paper at the Jackson Hole meeting years ago, and we've got the right guest coming up in moments on this. What is going to be the sea change of a shift from negative rates to positive rates, clearly within Europe, but frankly worldwide?
President Lagarde speaks a little bit later, Tom, 10:45 Eastern time. Your call, your focus, what is it?
My focus is simply how she will readjust off what you mentioned last week, John, was the migration from transitory in the headlines over to the shock of what we heard in the press conference needs some interpretation.
Yields picking up throughout Europe, in Italy, in Germany too. In its equity market, just a little softer on the S&P after the biggest weekly advance on the S&P 500 of the year so far, down about 0.1%. We're basically unchanged on the NASDAQ 100. Yields with a lift again on treasuries, 192 2.49, approaching 2% again. Euro dollar unchanged here at 114.44. And after 7 straight weeks of gains on WTI crude, a monster year-to-date move leads to 91.60. We're negative there, 0.8%.
Let's sit on crude for a minute because that really goes to the geopolitical issues of today. We are looking to Thursday for that CPI print, but today it is all geopolitics. 1:30 p.m., German Chancellor Olaf Scholz set to meet with President Biden, talking about the collaboration with respect to Ukraine, with respect to Russia. What kinds of sanctions are they willing to put on the nation? Also, what do they have in mind with respect to oil prices, considering the fact that inflation expectations in Germany have reached the highest level in decades? You see inflation surging, and we really have not heard Olaf Scholz explain what his view is on this, how he's going to get ahead of this, and what his tolerance level is with Russia, given that they are such a huge supplier of oil. Then, of course, later today, U.S. Secretary of State Antony Blinken is going to be heading over to Australia for 6 days, meeting with a number of allies in the Indo-Pacific region to talk about China and shoring up support in terms of different aspects of the U.S. relationship in that region. I just really keep going back to the connection between China and Russia at a time when the Olympics is going on, at the time when you've got geopolitical tensions rising that are enraging, according to both the alliance on the west and the alliance on the east. And at 3 p.m., the Federal Reserve is reporting U.S. consumer credit for the month of December after it surged to a near record high, at least in terms of a month-over-month increase in November. How much are consumers borrowing, given that they are supposedly flush with cash, given that they are concerned about how much inflation is rising? John?
Elisa, thank you. Tom is on his way to Beijing for an open spot on the Olympics team. They're so impressed.
We'll watch.
They're so impressed.
Yeah.
Christian Muller-Glissman joins us now, the head of portfolio strategy at Goldman Sachs. Christian, great to catch up with you, sir. This breakout in Italian 10-year yields, 2-year yields, take your pick across the curve. Is there anything to be worried about here?
Well, listen, I mean, the market is now going through a major reassessment of duration risk across assets, within assets. And I think we shift a bit from, I guess, the speed problem of these shifts. No, I think like kind of hawkish surprises in the front end, putting a lot of volatility into the rates market. We're shifting also into a bit more the level debate. You remember our framework is always level, speed, and source kind of matters in terms of these rate moves. And now the market worries about what type of levels, I guess, certain parts of the economy, certain parts of markets can actually deal with. And I think we would argue that generally our star for most developed markets economies are probably higher than market pricing is. And for Italy in particular, the conditions, the macro conditions right now are a bit more favorable compared to maybe previous episodes where you've seen sovereign stress. So we think that eventually, especially if the Omicron drag on growth fades and the EU recovery fund kind of supports growth, that the market will probably be comfortable with slightly higher rates in Italy, slightly higher yields. But in the very near term, it's very difficult. I think you could see some more widening.
Christian, I want you to take the sum of Goldman Sachs thinking out of London and frankly across continental Europe to the huge what if or mystery of how the commercial banking system and the financial system of Europe in itself shift from negative rates to revert to, I should say, from negative rates to a positive rate regime. Does it do it with stability? Does it do it with kinked reaction functions where there could be instability? What does Goldman Sachs perceive of that?
Listen, you make a great point. I mean, this is the other thing which is different right now compared to maybe previous periods of euro area sovereign risk concerns. The banks are doing really well. I think if you look at their kind of earnings, if you look at their shareholder returns, I think dividend expectations, dividends paid are kind of rising. I think at the margin, the restraint they've had during the COVID crisis has actually meant that balance sheets are strong. And we know that actually rising rates are not bad for banks on the face of it. No, of course they're bad if you trigger a recession. But if you don't, I think there is a direct link of profitability from banks to rates. Now, a lot of people might push back and say, wait a second, if the curve flattens and the front end rates go up more than the back end rates, that's not so great because banks are borrowing short, they lend long. But that's not completely true. We actually found historically that the front end level of rates can really be a boost to profitability as well.
Christian, this sounds like a familiar story, one that people have been saying since the beginning of the year. And yet at the end of last week and over the weekend, all of the research reports were people throwing up their hands and saying, this is a massive pivot. Everything changes. We have to now go long the euro. We have to reconsider all of our portfolio positions. Are you not kind of singing the same kind of tune there?
Listen, no, I mean, like, there is a massive change happening here, no doubt about it. I think we have, as I mentioned, a major change in the rates regime, which has huge implications for portfolio allocation. But it's in particular with regards to the role of bonds in the portfolio, the 60-40 portfolio. I think these type of strategies are under enormous pressure to rethink allocation. If you ask me with regards to Europe and this idea what Europe's place in the portfolio is, I still think that European assets are more resilient, are shorter duration on the face of it, and actually probably have more of a place in the portfolio in the coming years, subject, of course, to the Italian situation and sovereign risk not becoming an issue. And our team would say that we are in better conditions to digest higher rates than we've been in a long time. We expect BTP spreads to widen to 175 basis points, probably peak out there, and then start to come down as the growth picture confirms that the situation in Italy is not that bad.
Christian, when you wake up and you put on the Bloomberg terminal, you log in, you look across your dashboard right now, what would be flashing that would say, you know what, I've got to change my opinion on what's happening at the moment in Europe? Where would you be looking for that?
Listen, I think the thing I've been a bit worried about recently, and we spoke about that last time I was on, is obviously not just what sovereign credit markets are doing, but what corporate credit markets are doing. And you noticed in the last week that the kind of corporate credit spreads globally have continued to creep higher slowly, but in particular, iTraxx crossover has started to shift higher. And what I found peculiar in the last few days is actually that iTraxx crossover has outperformed its relationship with the V2X. So the equity volatility has actually been a bit too low considering how much credit has moved. So I think it tells us you got to watch credit. I think credit, we said already a few weeks ago, will be a bit of a kind of signpost on if the market and the economy is really digesting these higher rates or if you're facing recession risk.
Christian, for people who don't understand what you just said, because you mentioned some indexes that they might not be familiar with, you're comparing the cost of protecting against credit risk, let's call it, against volatility in the equity market. Just go through this a little bit more, Christian, because I think what you're saying is really important. We're seeing the cost of protecting against credit losses increase and volatility in the equity market continue to trend lower. That spread, how does it reconcile?
Yeah, I mean, listen, credit is essentially, following the academic world, is essentially short equity put, yeah? So theoretically, it's the same trade as selling a put. So the equity volatility should be very closely linked to credit spreads. And the iTraxx crossover is the CDS market, is the liquid way to track essentially what's happening in credit in Europe, in the slightly lower quality parts. And if you compare it, that very liquid measure, it's been ticking wider, so the risk premium has gone up, whereas the V2X, which is the measure for European equity volatility, has been lagging a bit. So it tells you that maybe the credit market is telling us there should be more concern in equity markets.
Christian, that was a clinic. Thank you, sir. Christian Muller-Glissman there of Goldman Sachs. Tom Keene, that is something we should all be focused on.
Well, we got to be focused on it. It's the movable parts. And again, what it comes back to, John, is ratio analysis, whether it's Europe or whether it's here, and that's simply compare and contrast. And John, I'm going to just make clear, the 10-year real yield in the U.S., which is, I'm going to call it the benchmark of all these dynamics, has really not given up the surge that we've seen the last 10 days. I mean, it's held there waiting for more news.
We've got this real yield story that Tom's talking about, and then this credit risk story versus what's happening with equities. I think that second piece at the moment is something really worth staying laser focused on as we work our way through this price action.
In the United States, you have not seen a tantrum. What we saw at the end of last week over in Europe seemed more tantrum-like to a lot of people who are watching, particularly that index, which tracks the crossover between high yields and investment-grade credits, and basically the implied risk premium the spreads widening dramatically.
You've confused everyone again now, Liz.
She's selling her essay again. She's selling
No, basically, people are getting concerned about defaults. That is the implication.
That is the right conclusion.
That's it.
Shahid Lahar, the head of G10 rate strategy at BNP. I tried to make it simple, Lisa, and then you confused everyone again. Yields up a basis point on 10s to 192.49. Equities up 0.1%. From New York, this is Bloomberg.
With the First World News, I'm Rishika Gupta. Russia's Vladimir Putin and France's President Emmanuel Macron meet today in Moscow. The Kremlin says the talks will be substantive, but it doesn't expect a breakthrough. Russia has repeatedly denied that it plans to attack Ukraine. The US and the UK say they are now almost 130,000 Russian troops close to the Ukrainian border. In the UK, a no-confidence vote on Prime Minister Boris Johnson could come as soon as this week. A minimum of 54 Conservative members of Parliament would have to support a vote. And the Sunday Times reports that some predict the total is approaching that. One Conservative lawmaker tells The Observer, quote, "It is going to end in him going." Over the weekend, Johnson filled 2 key positions after senior aides quit. And a state of emergency has been declared in Canada's capital over a protest against vaccine mandates and COVID restrictions. Hundreds of trucks have been parked in downtown Ottawa near the Canadian Parliament. The city's mayor says that increasingly rowdy demonstrations pose a threat to safety and security of residents. Frontier Airlines has agreed to buy Spirit in a takeover that combines 2 of the U.S.'s bargain carriers. The price, $2.9 billion in cash and stock. The private equity firm Indigo Partners owns a majority stake in Frontier and is the largest shareholder in Hungary's Wizz Air. The shares of Peloton are soaring today. The company is said to be exploring takeover options. There also are reports that both Amazon and Nike are considering making offers. Peloton stock has fallen more than 80% from a high a year ago. Global News 24 hours a day on air and on Bloomberg Quick Take. I'm Rishika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out
connection lost
from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance, and say, decisions.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Earnings season continues.
This is record revenue.
Not since the 1980s have we seen these sorts of reversals.
Strong earnings put investors' Fed fears behind them for now.
Bloomberg breaks the numbers first.
A big beat for Apple. Caterpillar earnings.
Got McDonald's earnings.
An expert analysis you won't get anywhere else.
The fundamental story is really solid.
The supply chain shortage is still very much real.
It's really kind of a balancing act.
You run the risk of not holding the stock that makes its peers obsolete.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The Build Back Better, as it has been presented over the last 7, 8, 9 months, that bill no longer will exist, okay? Should there be parts of it? Do you want to talk about different things? I think the president said there might be certain parts and this and that. My biggest concern and my biggest opposition, it did not go through the process.
That was Senator Joe Manchin, the Democrat from West Virginia, with Tom Keene and Lisa Brabitz. I'm Jonathan Ferro. Futures up, let's call it 40 on the NASDAQ, up 1/3% on the S&P, up 0.2%. Yields climbing higher on 10s in America in the Treasury market. Let's call it a basis point higher to 191.77. Euro dollar unchanged at 114.45 in Europe. That's probably the only thing that's unchanged right now. Big move in the Italian debt market. The 2-year yield up another 11 basis points. And just to remind you of where we opened up this time last week, the 2-year was -17. It's now +44. At the front end of any bond market, that's a massive move, Tom, as this ECB begins to make a huge pivot.
Yeah, you look at a 5-day chart of German 10-year, just as a benchmark, if you will, for Europe. And I'm sorry, John, the headline this morning is new high yields, new positive yield for the German 10-year, getting out to 0.2483%. Really,
Up 3 basis points. And Tom, we keep going back to it. You and I have covered this together for, I think, about a decade. I'd go back to a conversation we had 10 years ago. I was in London, you were here in New York City, and we were talking about the so-called Japanification of the German debt market. And now we're just slowly maneuvering this super tanker and bringing these yields back into positive territory.
And to the gentleman from Goldman Sachs that we spoke to moments ago, the real research idea here, John, is the path from accommodation, massive, historic accommodation. Where's the R-start, as he mentioned? Where's neutrality?
How far
Does
can
anyone
you take
know?
it? Bank of America have got their doubts. I mean, this came from Ethan Harris, Tom. They've changed their ECB call, but they say in 2023 inflation will be sub 2% again. Fundamentals aren't there. Hikes can only go so far. The what's next, what comes later part of this conversation, we haven't got there yet. This is just about pricing in something as opposed to nothing.
Well, let's look at what's next right now in Washington. We spoke of Ukraine and Russia earlier with Anne-Marie Horton. She's now at 1600 Pennsylvania Avenue and joins us this morning. Off of Joe Manchin's comments, Anne-Marie, it is about domestic legislation. What is the agenda this week?
Well, when it comes to domestic legislation, the agenda this week is obviously going to really focus on what that inflation print looks like. Many on the street are saying north of 7%. But I think you need to think about and look at how the president spoke about the economy on Friday when we had that surprise jobs report to the upside. The president didn't mention to build back better. Senator Joe Manchin there said that is dead. So what the president is trying to do is talk about pieces of it. And they are trying to talk about how they can help support the economy. And in that moment, he had mentioned about child care and how having a robust child care and the government helping give families, quote, a little bit of breathing room could potentially help more women get back to work. So they are still talking about their economic agenda, but there's been a tactical change in how they communicate that to the American public.
Have they communicated it to progressives? There seems to be such a fraction between central Democrats and liberal Democrats. Where does that stand this morning?
Well, with the president changing his tune slightly and not even mentioning the term Build Back Better, he's clearly moving a little bit to the middle, a little bit more. When many in the party have said the president has moved too much to the left last year. And this, of course, comes as we have a midterm election year. He is 8 months away from the midterms, where many are saying it is going to be a red sweep across Congress. And then if you look at the most recent The Economist and YouGov poll, what the American people think about the economy is approval rating for the president's stewardship at 39%. So at this moment, he's trying to get what he can get back done and what the American people want. And we've talked about this all last week when he was in New York. The Republicans are hammering the Democratic Party and this administration on 3 key issues that voters are going to come out to vote for.
Yeah.
Crime, inflation, and education of students.
Well, let's talk a little bit about the inflation aspect of this, especially as it relates to previous legislation, not only the future. I was struck by Jason Furman, who served on Obama's cabinet in terms of economic advice, giving economic advice. And he said, quote, in an article, the American Rescue Plan was well-intentioned but oversized. They erred on the side of too much. Even Democrats coming out and pointing the finger at some of these rescue packages for the inflation that we're seeing now. How much does that complicate future legislation?
It does complicate future legislation because that's why you can't get the likes of Senator Joe Manchin on board. He thinks part of this is why there was a fueling of inflation. That's why he wanted to hit last summer a strategic pause before we started seeing a real uptick in the inflation print. This creates a communication problem, but the White House would say that it was better to go big and make sure they can shore up the American economy and make sure everyday Americans could make ends meet than it was to leave them high and dry. So that would be their response. But as you say, Lisa, this is also a massive talking point for this administration. Why would you put more money into the economy when we're already seeing higher inflation? They would argue that this actually, whether it's childcare or lowering prescription drugs, would actually ease future inflationary pressures.
Are we doing a second round of happy birthdays?
Yeah, please.
No. Happy birthday. Happy birthday, AMH. Thank you.
Jonathan,
happy birthday.
You are in trouble.
I don't care.
Thank
From
you.
outside the White House, thank you. Thank you very much. Lisa, it's about building out the capacity of the economy. That's the argument that comes from the administration at the moment. Is Secretary Yellen had this to say to us, because there's been a question mark, Tom, about whether she would continue serving as the Treasury Secretary.
I was surprised by that.
We still have a huge amount of important work to do.
Yeah.
I have no plans to leave the Treasury anytime soon, in a statement to Bloomberg News, Tom.
Yeah, I frankly, I was surprised by it in Bloomberg with that coverage over the weekend. And it's just real simple. We are, John, typically at a time where you begin to hear jockeying about staff members and that. These are all exhausting weeks that these people have. But I was really quite surprised by the Yellen comments.
Well, people have been asking where the leadership's been coming from, Lisa, on this whole debate around Build Back Better, on convincing the public that they're doing the right thing as they try to push this bill through. We talked about Brian Deese, the National Economic Council director, not doing many broadcast interviews. I have to say, in the last several weeks, every time I turn the TV on at the moment, they're out there, Lisa, talking about it. They're engaging in a much, much bigger way recently.
It's difficult, though, because Janet Yellen is not necessarily a politician, right? I mean, she really was a policy member with respect to the Federal Reserve and elsewhere. So her role in that capacity, of course, is perhaps not her strong suit. I will say the interesting thing with her is the inflation call. The fact that she has basically said we are not seeing a wage spiral. This is transitory. She has stuck to her guns on that, does not think that it's because of the rescue package that we are seeing this higher inflation. And that debate seems to be fraying in terms of people sort of looking at a more entrenched inflationary regime.
She's not taking the Governor Bailey line and told everyone maybe don't ask for a big pay rise.
No one
is
taking
so much stick
his line
off the back of that.
And rightly so.
Economists and central bankers scared of wage increases, but never telling off corporations about margins if you're at the central bank. I saw a lot of people make that comment on Twitter over the weekend, and it's true. It is true. Futures unchanged on the S&P from New York. This is Bloomberg.
this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
From New York City this morning, good morning to you all on TV and radio. Here's the price action. We're positive just about on the S&P, up by 0.05%. On the NASDAQ, doing okay, up by 0.14%, and moving the other way on a Russell, the small caps negative, about 1/10% or so. Not much price action in the equity market, tons to talk about in the bond market. So let's go there. 2s, 10s, and 30s. Your 10-year yield, 192.49, yields up about a basis point. Your 2-year yield, 130.85, yields up year to date in a massive way. Year to date, yields up by about 58 basis points. It's felt ugly, hasn't it? On a 2-year, a move of 58 basis points year to date in the Treasury market. Now picture this, 58 basis points up on an Italian 2-year in just 6 trading days. Same move, 6 trading days off a much lower level. Your 2-year in Italy right now, 46 basis points, up 13 basis points on the session. Tom, that's got to get the attention of this ECB. That is a very, very quick move. Goldman were on the program with us in the last hour. They talked about the source. They talked about the level, the speed. The source is the ECB. The level is 46 basis points. The speed is what gets your attention.
Yeah, I'm going to watch on attention meter for those in America today, the 10-year real yield, for that to break through to a new, lesser negative statistic would be a big deal. We're not there yet. John, in the equity markets, the drawdown right now, SPX close on Friday, is only -6%. So that shows the equity resilience is out there.
You're going to call that resilience? It's found pretty dicey at times. 20% moves on single names. It's been tough.
There's a bull and a bear case, and I'm not going to pick a side.
Okay, we shouldn't pick a side.
Let Romain pick a side.
He can do that in just a moment. Looking at Europe, Lisa, I'd have to say, this is what I would say to people who are wondering when this story in Italy is going to bleed out to the rest of the world and get dicey, get troublesome. Look to credit one, but I would also say this. If you start to see the euro move the other way, weaken as opposed to strengthen, if you start to see banks not rally but sell off because they're concerned about what's happening in, say, Italy, banks are just about positive, and they did nicely last week at times as well.
This is to Christian Muller-Glissman's point of Goldman Sachs, where he said that the creditworthiness of Italy, the creditworthiness of banks is much more solid than it has been in the past. How much runway does that give Christine Lagarde to go ahead and remain hawkish?
Bank of America say we're underestimating the Fed still and overestimating what the ECB will do. We'll build on that. That's your cross-asset price action. Let's get you some single names this morning and say good morning to Romain. Good morning, Romain.
Hey, good morning, John. A relatively quiet day this morning, at least as far as individual movers go. Rates are really driving sentiment right now. As far as what's moving, though, there is some M&A activity out there right now. Spirit Airlines and Frontier are said to be combining. Frontier basically paying about $25-26 a share for Spirit Airlines, about a 19% premium to where we saw the shares on Friday. Spirit Airlines up about about 12%. Frontier down about 2%, but it's actually putting a bid under a lot of other airline stocks out of there, including Delta, JetBlue, and American Airlines. Speculation now about additional M&A activity. We should point out Spirit and Frontier, two of the smallest airlines here in the U.S. based on revenue. Even when combined, these companies probably wouldn't even rank in the top 5 or 6 below Alaska Airlines, just to give you some perspective there. Flip up the board, some other M&A speculation, this belonging to Peloton. Some reports out of the Financial Times and Wall Street Journal suggesting that Amazon and Nike are apparently considering bids to buy Peloton. Of course, the shares down more than 80% off that all-time high back in January 2021. The shares getting a little bit of a pop this morning, 32% higher at $32.50. Remember, these shares last week closed below that IPO price, which is just a little more than 2 years ago. Alibaba shares down about 3% here in the pre-market. The ADRs, I should say, a filing by Alibaba over the weekend seemed to suggest that maybe SoftBank is looking to unload about $1 billion worth of ADRs into the U.S. here. So keep an eye on those ADRs there. And Snowflake higher here, up about 5%. The software company getting an upgrade over at Morgan Stanley.
Romain, thank you so much. Greatly appreciated. Mona Majan is two of the most prestigious degrees out of the shop, known as the University of Pennsylvania, in computer science and also, of course, across all of economics. She joins us right now with Edward Jones. I want to go back to that dreaded sophomore course, Mona, statics and dynamics. It's like the first course where you have to actually think about what's going on in math and in the engineering space. What are the statics and dynamics right now that matter in an equity market where our listeners and viewers are getting whiplash from this guy's bearish, this guy's bullish, this guy's bearish, this guy's bullish? What matters now in the statics and the dynamics?
Yeah, it's a great point, Tom, and thanks for bringing up my alma mater, Penn. You know, look, the markets have been on edge really since the beginning of this year, and perhaps rightfully so. We've had two dynamics at play, not only a Fed that is about to undertake what could be a very aggressive tightening cycle, but we've also had fiscal policy that now is pulling back the spigot as well. So markets for the first time in quite some time are facing less liquidity and tightening economy overall. But, you know, how has this played out in the market? Well, certainly we've seen valuation compression across the board. Perhaps the most hardest hit in that have been speculative asset classes, higher valuation asset classes. But what we haven't seen yet is any sort of earnings revision, downward earnings revision momentum. And that to us has been a positive sign. You know, of course, we've seen volatility around earnings reports throughout this season. But Q4 21 is still looking to be a good 25 to 30% year-on-year growth. Notably, 2022, yes, we'll get moderation, but we're still looking at 8 to 9% positive earnings growth. So for us, you know, when we take a step back, we think the valuation compression story, you know, makes sense to us. We've seen that happen historically as the Fed undertakes rate hikes. But we're still positive and we're still hopeful that the underlying economy and the fundamentals looks relatively sound to us.
Okay, that's earnings down the income statement, wherever you want to select it. What do revenues do? How do you link GDP and the assumption of slowing GDP back over to corporate revenues?
Yeah, you know, look, I think, you know, to your point, GDP growth this year overall for the year, probably still looking at 3.5 to 4%. But how does that play out over the year? Well, part of that is somewhat front-end loaded. So as we get to Q4 of this year, we're probably looking at GDP growth perhaps a little bit under 3%. How we're seeing that play out in corporate earnings? Well, the front end, the first half of this year is really very much driven by those value and cyclical sectors of the economy. So think financials, think energy, think industrials, think a lot of those reopening plays. They have better comps in the first half of the year. They're going to see better earnings growth in the first half of the year. As we get towards the back half of this year, we are really looking back towards those growth and tech sectors to drive earnings momentum once again. You know, as growth slows in the economy, investors tend to look for higher growth names. They also tend to look for somewhat more defensive names. So we also see areas like staples hanging in there as the economic growth picture moderates, but still remains above potential.
Mona, have you changed anything about your investment view after last week, which a lot of people said was a massive pivot point for not only the Fed, but also for the ECB?
Yeah, you know, we're certainly watching globally what's happening with yields, and it is certainly interesting to see positive yields once again across the globe. You know, for us, what that really means is as yields tighten, we think, you know, we could see yields move towards 2% here in the U.S. that really does support value cyclical names. So we actually tend to go back to our core playbook, which is the first half of this year will be driven by not only value cyclical, but we do look outside of the U.S. Keep in mind, not only does non-U.S. and EM perhaps have some catch-up to play, but they also are less exposed to those higher valuation, more speculative tech assets, which tend to have been underperforming in this environment. As we get to the back half of the year, as we noted, we are looking for opportunities forming in the tech space and perhaps somewhat in the defensive areas as well. But our core playbook remains value cyclical, non-U.S. EM, and then start to balance it with the more growthy names as we head towards the end of the year.
Mona, in just about a minute, at what point do bonds start looking good again? If yields start going up, and if we do get to a place where growth is decelerating as you expect by year end?
Yeah, it's a great point. And look, for us, bonds are down but not out. And, we do think they have a place in a portfolio for not only you do get a little bit of pickup in yields, especially versus those, government bonds, but areas like investment grade and even parts of high yield have been a defensive asset, especially as we've seen equity volatility increase. And so as a defensive hedge in your portfolio that perhaps has a pickup over cash and cash equivalents, in a year where we do expect equity volatility to remain elevated, we think there is room for a bond portfolio, of course, in the overall spectrum of where you see your own risk appetite falling. But generally speaking, we do think not only U.S. Parts of high yield and investment grade, but look non-U.S. as well. We think there's opportunities there too.
Mona, thank you for being with us as always. It's good to catch up. Mona Mahajan of Edward Jones. Cameron Christ just publishing on the Bloomberg. BTP's after a reminder that tightening has consequences. He concludes, how high do BTP yields have to go before the ECB reiterates a cautious approach? We may be about to find out, Tom. Yields up at the front end again in Italy by 12 basis points.
We got Italy, and this is more so than just a compare and contrast to the economy of Texas. I mean, Italy really fits in here with the center, the core of Europe, John, something Martin Feldstein used to talk about all the time. You wonder how the core is going to react to this new world.
It's just the size of the debt market in Italy. It's just huge. And to see the 10-year yield up another 12 basis points to 186, so it's not the level yet. It's just the rate of change, the speed of change, Lisa, is just quick.
Yeah, but at the same time, if the ECB can't say that they're worried about inflation without a freak out that they're going to then backtrack on, then they're held hostage. What sign does that send to markets if they basically say, actually, our job is to compress spreads in the euro regions and the peripheral regions? How much does that actually, create a policy that's really negative?
That's the trillion-dollar question, multi-trillion-dollar question for 2022. How durable is the Fed put for the ECB? Looking at Italy, can they back off with inflation where it is, in the 5s in Europe and in the 7s in the US?
And honestly, how much do they push back? How much do they try to jawbone this back at a time when it's not causing material distress in the financial sector, at least as of yet?
Not yet. Yet. You love that word, don't you?
Well, I mean, that's what everybody is saying. It's like things move quickly, things could break, but so far it's not.
We're on the same page.
Good, glad.
ECB President Christine Lagarde coming up a little bit later. You'll hear from her, a speech, I believe, out of Europe. Coming up next on this program, Jordan Rochester of Nomura on foreign exchange. Don't miss that. Futures up 0.8 on the S&P from New York. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. This week, data are expected to show that inflationary pressures in the U.S. kept heating up at the start of the year. That will probably put a Federal Reserve interest rate increase next month on autopilot. According to a Bloomberg survey, the Consumer Price Index likely jumped 7.3% in January from a year ago. A member of the European Central Bank's Governing Council sees an interest rate hike as early as October. Klaas Knot told Dutch TV that a 25 basis point increase is likely. Knot said a second rate hike can then take place in the spring of 2023. He's considered one of the ECB's most hawkish officials. The pandemic and China's restrictions to control it are still damaging domestic spending. Travel and consumption during the just-ended Lunar New Year break was down from 2021's already low level. People in China made 251 million trips during the 7-day holiday. That's down 2% from last year and a 26% drop from 2019. And in Hong Kong, the number of coronavirus infections is now doubling every 3 days. The city reported a record of more than 600 cases. That puts pressure on the government to ramp up restrictions as it tries to eliminate the virus. In Sweden, price comparison provider PriceRunner is suing Google for about $2.4 billion. The case follows an EU ruling that said Google has breached antitrust laws by favoring its own comparison shopping services. Google says the company is looking forward to defending its case in court. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the House for business's greatest minds.
The U.S. has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
Difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
talk around 50 basis points. I think it's lowering the terminal rate. So even if term premium is going up, if I think that the Fed is going to have to cut rates next year because they've overdone it, that is overshadowing this idea that long-term rates should be higher.
Love catching up with Priya, one of the best in the rates market. Priya Misra there, TD Securities Head of Global Rate Strategy with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your price action in this equity market shaping up as follows. Up 40 on the Nasdaq 100, up 0.25%, up 0.2 on the S&P. Yields higher by a single basis point on 10s in America to 191.77. Up a whole lot more in Italy through the curve, twos all the way out to the long end. Euro dollar TK unchanged here at 114.49, but wow, have we got a ton to think about.
A lot to talk about as well this morning. Let's get a briefing on a Monday. Kriti Gupta with us with a chart. Kriti, what do you have?
Yeah, Tom, let's talk about the majors. I don't mean baseball, of course. I mean currency pairs. We know the hawkish highlight of last week was, of course, the BOE and the ECB. So my chart of the day looks at how that played out in the currency market. You actually saw the BOE talk about a 50 basis point hike, 4 members voting for it as they kind of try to tackle those dramatic jumps in the cost of living. The ECB, a similar story with Lagarde saying optionality is on the table. For a radio audience, what you need to know is the chart of the day looks at the euro against the pound. That's actually bouncing off that key Brexit level. That's going to be a key technical level that you want to watch going forward. But to me, what was interesting was that as we talk about a more hawkish BOE, you would think that would yield a stronger pound. But instead, it kind of seems like the ball is in Lagarde's court here. The idea that the more kind of questionable what could happen next comes from Lagarde. Of course, we're going to be hearing from her later today. And Tom, I read the research. I read what everyone is thinking on Twitter. But I think, honestly, I have a bias here. The best kind of quote to sum this entire thing up comes from our very own FX strategist, Vasilis Karaminis, over in Athens. He said, the bigger the crisis, the bigger the silver lining for the euro. Once again, the ball being in the ECB's court.
Kriti Gupta, thank you so much this morning. And now a special treat on short notice. Jordan Rochester with us, G10 foreign exchange strategist at Nomura. Mr. Rochester, of course, looking for weaker sterling. We can talk about that. Jordan, I love how you go deeper and you look at a Belgium, and if it's Tuesday, it must be Belgium. If it's 7.59% inflation, it must be Belgium. They're out 5 standard deviations in inflation looking back 20 years. How big a shock is this?
It's a big shock for economists and the ECB, who had been very focused on a German VAT base effect that was going to kick in January, and we got it. But those economists and those forecasting it had not just looked at the situation with energy prices, not looked at the PPI situation. Whatever happens in European producer prices comes through to official inflation 2 months later. And then, as you say there, Belgium was the canary in the coal mine. We got the data for Belgium a bit earlier than the rest of the pack, and that had another explosive rise higher in its CPI. So again, I was on holiday last week, watching from a distance the markets on my phone and my emails. Surprised how surprised the markets were to this inflation release. Now, the ECB has turned more hawkish earlier than I expected. I thought they were doing it in Q2, Tom. And because of that inflation number, it's brought all of this forward. The question is, do you buy euro here? It's already moved quite a bit already.
8 years ago, summer of 2014, euro dollar pushing 140. The ECB wanted it a whole lot weaker. They went into negative territory on the depot rate. They didn't turn back. Further negative, further negative. Jordan, that story could change. We could have a positive interest rate of the ECB. Maybe, I don't know, maybe in the next 12, 18 months. Jordan, how much of a big change would that be for euro dollar, for that currency pair?
It could be a big deal. For me, it's about timing. So we have Q1 this year, euro going lower because of a growth slowdown, because of China growth slowdown, because of gas fears, energy prices, the trade balance going into deficit for the euro area. But from Q2 onwards, our path for euro is it goes to 118 by this year end. And the risks are it goes higher than that, given when I made that forecast, we weren't thinking about the ECB raising rates by 25 basis points, as not seemed to suggest this morning. And so if the ECB was to raise interest rates, why is that a big deal? Well, you've got years of the carry trade, years of European banks lending to American corporates, aware that they've got 0 to negative interest rates in Europe and the US has a positive rate of return. You could see that lending by European banks to American firms dry up as that yield differential will narrow, and that could really boost the currency. I'm thinking this more for Q2, Q3 onwards, John. That's when I think that story really plays out.
Jordan, then how do you respond to people who say the ECB will pivot before that back to a more dovish stance because of what we're seeing in the peripheral spreads, the fact that there has been such a dramatic move upward in yields?
It's a fair point. I mean, I've been on the inflation angle of this argument for months now, going into the end of last year and beyond. But now we've got peak inflation pressures from energy. So PPI is actually going to cool off in Europe. The wage story in Europe is also going to pick up, though. So with a lag, you're going to see the inflation from today feed through to other factors. So it keeps the ECB on that hawkish path. But you're right in saying there's a risk for periphery here. If Italian BTP bond spreads keep exploding the way they are, that's going to really weigh on Italy. It's going to really weigh on its politics. And there is an election next year. There's also a credit impulse slowdown in Europe. PMIs are falling. So the only way to bail out the euro area is if you have some fresh fiscal stimulus, and I think maybe that comes from China. So a lot rests on this Beijing Winter Olympics. As soon as the Olympics are over, do we see Russia invade Ukraine? Do we see China turn on the stimulus taps and pick up production again? Two massive questions going into the end of this quarter. So for the time being, the ECB is in a really tricky place. They're keeping their options open. All they've done is signal they might raise rates. They've seen the market overreact. So now there's a question about how soon do they really end QE? And it's a bit of a tough one, so I understand that. And that's why you're having people ask those questions.
Jordan, can we talk about where stress would show up in Europe? The last time around, we saw it on the periphery, obviously, in the banks, in the credit market. We didn't see it so much in the actual single currency. In fact, when we were really talking about the height of redomination risk in the euro area, the ECB still had the problem of a currency that wouldn't weaken and wouldn't weaken quickly enough. How do you think that dynamic's going to play out this time around if we did push it that far, Jordan? If we saw this explosive move on the periphery in yields, what it would mean for the single currency?
It's a good question. There's so many factors. One, the trade balance is basically in decline right now, thanks to high energy prices, and exports to China have slowed down. So that trade surplus that Europe brought in, essentially from 2010 onwards, to fix the situation for its flows, well, that's going to not be the same as it was. So a strong trade surplus is no longer the case for Europe. I actually think if we had the very latest number, which we don't because it's lagged, we'd be in a deficit thanks to gas prices and oil prices rising. So from a trade angle, you don't have that stronger euro impulse. But from the financial side, John, because the euro has been the funding currency of all these high beta trades, going long the US stocks, going long emerging markets, risk off is actually sometimes positive for the euro. So I'm actually questioning how much does the euro sell off if you have risk off. And so I think that financial flow is so big, the banking flows, that you actually have a stronger euro in the case of a risk off, unless you have something from the ECB say, actually, we're going to go dovish again, which I doubt they'll do straight after turning slightly hawkish.
Jordan, thank you, buddy. It's got to catch up. Jordan Rochester there of Nomura out of London. Tom, these are complex issues in the continent.
There's split here between flow study and real rate study, and what we heard from Jordan there is he's doing both. That's how odd it is.
Tom Keene, Elisa Bramett and Jonathan Ferro. Futures up 1/3% on the Nasdaq, up, let's call it 0.2 on the S&P 500. Tons to work through as we count you down to CPI this coming Thursday. Your estimate 7.3% in America. From New York City, this is Bloomberg.
estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City,
in London, in Sydney, in San Francisco,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
to recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Inflation statistics continue to look extremely elevated.
Inflation in the wage costs. We're talking about inflation in materials, inflation in logistics.
I think that in 6 to 9 months, we're going to be having a very different conversation around inflation and demand.
Every bit of evidence we've gathered tells us that we're going to see that turn.
I think it's going to start to plummet like a rock.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thrilled you're with us here on radio and television. A follow-on from a stunning Friday. John, I'm watching the U.S. 10-year inflation-adjusted yield, and it has a persistence to go to a lesser negative number.
Looking ahead to CPI on Thursday, Tom, the median estimate 7.3, the high estimate 7.6, the low 7. So most of the street, all of the street, expecting the 7 again, a 7 handle in America. There's a new element, a new ingredient in this recipe for a bond market sell-off, though, TK, and it's Europe. There is a big shift taking place in the European debt market.
You've mentioned Italy all morning with Jordan Rochester of Nomura. We just mentioned Belgium out 5 standard deviations, 7, rounded up, John, 7.6% inflation in Belgium. I know it's a one-off statistic, but what if we only come back so far and embed, say, 3% inflation?
Then the ECB's got some work to do, and maybe they've got some work to do just to get it back there. Tom, this 57 basis point move on the US 2-year year-to-date has felt like a big move. We've had the same amount in Italy in 6 trading sessions. That is a monster jolt as we hear more and more banks just price in more and more hikes from this ECB.
I read a lot this weekend, folks. Really leaned over after the shock of Friday. Lisa Abramowitz, your observation on a Monday after the shock of the labor report Friday.
Trying to understand the balance sheets of the global central banks of the developed world. How much does quantitative tightening actually mean a rise in yields that we cannot prepare for because it will happen all at once? The other issue is, will they go through with it? I mean, we've been talking all morning about the Fed put, about the ECB put, and there's this feeling that a lot of companies, and this is actually really important, have extended their maturities long enough. They have enough capital under belt that they can withstand this, which means we can see more tightening than we ever have before in history, Tom.
And John, to get to our good guess, let's go through this quickly, but that's that linkage between full faith in credit, sovereign analysis, John, and the credit analysis you and Lisa do so well.
And corporate credit's just getting a little bit more fragile. A little bit more fragile at a time when the equity market's starting to look resilient. We can build on that through this morning. We're up 50 on the Nasdaq 100, up a third of 1%. On the S&P, we're up 9, up 0.2 of 1%.
Equities lift.
A lift in the equity market, a mild one, but it's there. Yields higher too by a single basis point. TK 191.59. Euro dollar unchanged at 114.53, and it gets your attention. Crude in the 90s, 91.33. We come back 1%, but we've had a monster move year to date.
I would say Brent crude resilient, 92.75 on Brent crude to break through to a new high level there, as Javier Blas suggests, would be really interesting. Let's get right to it and advance for Global Wall Street, the story of this February. We can do this with Saeed Ladha, head of G10 rate strategy at Americas at BNP Paribas. Saeed, I love your research note, and what I note there is the migration from 4 to 6 rate hikes in the United States. What do you need to see to ever go more from 6 to 8 rate hikes?
Absolutely. Thank you, Tom, and thank you for having me. Look, I think we've been on the hawkish side for some time and really opening up the distribution to more. There is a question of length of runway, and I think that question is even more asked now with the ECB and the Bank of England being a little more aggressive on exit plans. The Fed needs to move. The Fed needs to move quickly. It's clearly behind the curve, and 6 rate hikes may be more the center of the distribution. We can see more.
Wow.
We could see 1 every meeting, and we don't rule out 50 or a Fed funds rate at close to 2% at year end.
Shahid, let's just build on what you just said, the length of the runway. Does it make it easier or harder that they're all trying to do this at the same time?
Look, I mean, we've heard from Powell this time is different. That's something we've said before. And how this time is different, we think, is with velocity. This is about pace of the recovery, pace of the exit on both the fiscal and the monetary side. And the second is synchronization. Synchronization again, between the fiscal and monetary forces, both heading for the exit post-pandemic, but also the synchronization between different central banks moving at the same time. Look, ultimately, I think it might be more difficult for asset markets and the global economy, as central banks move increasingly together on the exit, on both the balance sheet and the level of rates.
This is why I think it's important to call it regime change, Shahid, because in the previous regime, we'd see a bond market sell-off and believe it was self-limiting in many ways because these central banks would have to back away. When we think about a change in regime, Shahid, are you thinking about maybe that dynamic doesn't exist anymore?
No, actually. So I think we can get to where we're going quicker, which is velocity part. But I don't think the destination in itself has necessarily changed. We don't think that the new normal for the long-term or neutral rate is above 3%. So we still feel like term yields are somewhere capped below 3, probably tends at 2.5 or below. So we think we can get there quicker. We can get to 2 and above quicker, but we're not convinced we go above. There remains a lot of liquidity in the system and lots of fixed income duration demand, which we think comes in if and when central banks reach their peak, perhaps quicker than before.
Shahid, what you're describing sounds like it's screaming yield curve going down, going negative for the first time in a long time. Inversion, excuse me, it's Monday, I'm having trouble. But honestly, going forward, how much is that a concern? That basically you're saying the Fed is way behind the curve and that seems clear to you. Why are we not necessarily forecasting a recession sooner if that really is your base case?
Look, it is a concern. We do have the curve flattening. We certainly see 2s10s mechanically flattens basically to 0 through the rate cycle, and at the end of the rate cycle ends at 0. Likewise, 5s30s often move the same. So clearly the risk is the curve continues to flatten under the scenario we've outlined. But I would probably like to answer that with a counter, which is what's worse, a flat or slightly inverted curve or a super steep curve because maybe the market can't take all the duration, or because inflation becomes much more of a long-term risk and fear than a relatively short-term one, which is priced. So I think a flat curve is not ideal for the Fed, but I think it's perhaps a better evil than a very steep curve with credit implications as well.
Shahid, you're talking about consumer sentiment. How much does that play into the ECB's perspective as well? We heard about their concern about oil prices, sure. The labor market is not quite the same. How much are they trying to get ahead of people believing in inflation that they have not seen in decades?
Sure. I mean, look, the ECB and I guess to some extent the BOJ are in a very extreme level of monetary policy that they felt maybe they'd be stuck in for some time. And I'm talking about negative interest rate policy, and that comes with a bunch of costs and unintended consequences. So to some extent, I think the ECB should embrace the ability to get through negative rates back into positive territory, which we think they get to zero at the end of this year and positive next year. But clearly, we've seen from Belgium this week, Germany last week, and across the Eurozone in recent months, inflation is not a figment of the ECB or anyone else's imagination. It's real. Yes, the labor market is different. It will take time, probably, for wage growth in Europe, but we think it's coming. And therefore, we think the ECB needs to be somewhat on the forefront of exiting and at least getting back to zero or positive rates.
Shahid, you've just finished on something that I think is really important. We spent a long time since the ECB went into negative territory 8 years ago in the summer of 14, discussing how beneficial that was actually for the ECB to do so for the European economy. What do you think to the argument that maybe this might help the Eurozone economy getting back to zero, getting back to positive territory?
I think it can help. I think it can help. You know, some inflation, a much better labor market, wage growth. I think we can change, or we hope to see a shift in the structural level of growth and inflation in Europe to a better level or a better place. Hopefully, we can see the same in Japan over time too. So, yes, we're worried about inflation, and in the US and UK, it's extremely high, and perhaps it will be more of a challenge to bring it down. But in regions that have gone years, if not decades, without without positive inflation and without a positive central bank rate, this is, we think, a positive outcome or good evolution.
Shahid Badha of BNP. Shahid, fantastic. As always, super smart and great to catch up with you, sir. BNP Paribas, Lisa, looking for 50 basis points of rate hikes from the ECB this year, I believe, 25 in September, 25 again before year end, then another 50 basis points through 2023.
Shahid really pointing out, though, the conundrum for the Fed and, frankly, for the ECB as well. Are we really getting out of the low-growth, low-inflation paradigm over the longer period of time, or is this just how we get there? And are they perhaps a little bit too far behind the curve to orchestrate something that gets there softly without some sort of downturn?
When you're thinking about a bond market sell-off, I thought the way Goldman framed it a little bit earlier this morning was correct, Tom. You think about the source, the level, the speed. The source, the ECB, the speed, super fast, the level. I don't think we've got a problem just yet. What BNP Paribas are talking about also is the synchronization. It's not just the Fed and the Treasury market. Yeah. It's not just the Bank of England and gilts. It's now the ECB and the Eurozone debt market as well, from bunds to BTPs. And that's something we've got to think about in a way we haven't been able to for a long time, Tom, because the ECB sat out the last rate hiking cycle.
All of that is correct, John, but I would do a behavioral overlay of the percentage of people involved in the game who've never experienced this. I think that's highly unusual coming off before the Volcker era and along the Great Moderation as well.
I remember sitting down with Andrea Rochelle of UBS at the time. He was running the investment bank, Tom, just before the last Fed rate hiking cycle, and asking him the average age of the trading floor and how many of them actually seen Fed rate hikes. Yeah. Tom, asked the same question of any trading floor in the Eurozone right now. The last rate hike was 2011. It was July 2011 with President Trichet and President Draghi, 8 years on the job, no rate hikes. There's a lot of people who have never seen this before, Tom, to your point. Tom Keene, Lisa Brammitz and Jonathan Ferro. Futures positive on a NASDAQ, on the S&P up a third of 1%. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Russia's Vladimir Putin and France's President Emmanuel Macron meet today in Moscow. The Kremlin says the talks will be substantive, but it doesn't expect a breakthrough. Russia has repeatedly denied that it plans to attack Ukraine. The US and the UK say there are now almost 130,000 Russian troops close to the Ukrainian border. In the UK, a no-confidence vote on Prime Minister Boris Johnson could come as soon as this week. A minimum of 54 Conservative members of Parliament would have to support a vote, and the Sunday Times reports that some predict the total is approaching that. One Conservative lawmaker tells The Observer, quote, "It is going to end in him going." Over the weekend, Johnson filled 2 key positions after senior aides quit. A state of emergency has been declared in Canada's capital over a protest against vaccine mandates and COVID restrictions. Hundreds of trucks have been parked in downtown Ottawa near the Canadian Parliament. The city's mayor says that increasingly rowdy demonstrations pose a threat to safety and security of residents. Frontier Airlines has agreed to buy Spirit in a takeover that combines 2 of the U.S.'s bargain carriers. The price, $2.9 billion in cash and stock. The private equity firm Indigo Partners owns a majority stake in Frontier and is the largest shareholder in Hungary's Wizz Air. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Rishika Gupta. This is Bloomberg.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
This is a molecule crisis. We're out of everything. I don't care if it's oil, gas, coal, copper, alloy, you name it, we're out of it. I've been doing this 30 years and I've never seen markets like this.
That's not a random man on a podcast at a dark room somewhere. That's Jeff Curry of Goldman Sachs. And Tom, to hear Jeff Curry speak like that, you pay attention.
Yes, there's no question about it. That's a huge statement. And, you know, there's a lot of big thinkers on this. We're going to talk to one here in a moment, John. But, you know, excuse the pun, it's incredibly fluid right now here with a race to $93 Brent crude.
Without a doubt. Let's whip through it for you. Futures are positive this Monday morning. Good morning to you. Up 0.25% on the S&P. Into the bond market, yields are higher in Italy, much, much higher, at more than 10 basis points at the front end and through much of the curve. Up a single basis point on treasuries to 191.59. And there's the move in crude, Tom. We're down on the session by 0.9%, but just to see it in the 90s again.
Yeah.
91.45 on WTI.
Our most anticipated conversation today on commodities that Mr. Curry was speaking of, Managing Director of Global Energy, I should say, at J.P. Morgan, Christian Malik, joins us right now with a blistering research note of what happens when the plus exits from OPEC plus. I really need to start with this, Christian. I think it's so important. If Russia does something odd in oil, that gets you to maybe $150 a barrel oil. How do you do a probability outcome of that? How do you weight that likelihood?
It's interesting. I remember when we last spoke, Tommy, we talked about the risk premium associated with when spare capacity falls. And when we broke the report on spare capacity, we talked about not necessarily the how, but what happens when spare capacity falls to 5-6% of total OPEC capacity. Well, this is analogous to this in the situation where if we see oil potentially being redirected towards the east, or Russia's spare capacity disappointing, whether it's voluntary or whether it's a bit more strategic, the bottom line is this: that equates to roughly $20 to $30 above where the clearing price for oil is. And that's how we think about it. We think about it as far as a risk premium is concerned.
Because of the events at the White House today with Ms. Scholz, Anne-Marie Horton, folks at the White House, Germany will discuss Ukraine, Russia, and other topics. You and your team are expert on the natural gas dynamics of continental Europe. What is your single brief to our American listeners and viewers of how nat gas in Europe is different?
Well, yeah, nat gas is different in a few ways. Let's keep it simple. First of all, you know, you're very close to Asian markets where there's a lot of liquefied gas, which is essentially the liquid version of natural gas. And the reason that's important is because you can send it over through ships, regasify it, heat it up, and it can be used in Europe, which has traditionally been almost like a dumping ground for LNG in the past. The second point is that you've got a lot of pipe gas, which is available clearly through Russia, but ultimately it is available. And I think those two things combined means that we think European gas will ultimately, while it will stay tight, we don't think that European gas is going to be threatened by major outages, even if it's strategic or linked to the Russia-Ukraine crisis. In fact, where we see risk is potentially through oil as opposed to the gas piece within Europe.
And this probably is the sort of elephant in the room that's keeping prices going higher in general today, notwithstanding. Right. What's the downside to oil prices if, say, this issue does resolve without a conflict and oil from the plus keeps on flowing?
You're right. I mean, in fact, when we think about this sort of $20 to $30 risk premium, I'd say we're probably only around low single digits on what the Russia-Ukraine crisis implies. I think ultimately, if it all, God willing, passes, there is ultimately still a tightness in the market as a result of OPEC not the OPEC Plus disappointing on production and inventories falling. So I don't think we'll see that risk premium completely disappear. In some ways, we're earning it month on month as we see the numbers from OPEC continue to disappoint, as we see demand or pent-up demand. So if anything, what we may end up having is a bit of a perfect storm where Russia-Ukraine passes, but we have massive pent-up demand into Q2, just at the time as OPEC is under-delivering on production, which therefore creates this tightness. And the point I make is this: when we think about risk premium, which we haven't had for years, it's very difficult to pin down exactly where they could emerge from. I'd argue that it could be anything. It could be UAE being attacked, it could be Kazakhstan. Any geopolitical problem ultimately just continues to chip at that risk premium, even notwithstanding the Russia-Ukraine crisis.
Which oil major then, Christian, in your view, stands to benefit the most from this tightness that you see?
In a nutshell, Shell. It has the highest gas exposure through its liquefaction. And back to the early question about Europe, it's the company that can provide the most in LNG, given its scale. And it's also very geared to oil prices, given it's got very high margins, and through marketing too, with the benefit that they're looking to return as much cash as they possibly can. So you've got exposure to the rising or tightness in the macro, with a lot of conversion into cash and cash return back to shareholders. And it's very cheap when you think about it. Generates the same EBITDA as Exxon, yet it's 40% lower on the market cap. So very good on value, particularly from a sort of US or global investor standpoint.
Hey, Christian, can I just say, great call. The last time we caught up with you was the start of December. Brent was at 69, so 93 now, and you were super bullish back then. Christian Malik of JP Morgan, thank you, sir. Thank you very much. TK, 93, he doubted the capacity of some of these OPEC countries, and this market's looking tight.
You know, it's always, John, the unexpected get you. And I really wonder, within all the economics and the ballet between financial policy or economic policy and just sheer economic growth, if commodities will be the unexpected. All my radar's up on that.
To hear people like Christian, like Jeff Curry speak like this, Lisa, that quote from Jeff Curry, this is a molecule crisis. We're out of everything. I've been doing this for 30 years. I've never seen markets like this.
I love it. I don't care if it's oil, gas, coal, copper, aluminum, you name it, we're out of it. How much does this show the limits of a world that is dependent on just-in-time delivery and filling houses with stuff and driving vehicles filled with stuff? How much is that unsustainable at this point, at these levels?
The stock's doing okay. Tom, another lift here. The Nasdaq 100 up 62.
It's the way it's lifted,
4/10. The S&P up 1/4 of 1%.
The report, folks, for those waking up, is, you know what, it's a fractional lift, but it's the way it's a lift and a carry forward of the shock of Friday. John, we can't say it enough. Friday was stunning.
Friday was stunning, and this move we've seen in Europe has been stunning as well. It does start to come back. The sell-off in the Italian debt market fading a little bit here. We were up 10 basis points plus on an Italian 2-year. Lisa now up just 5 on 2s. On 10s now up 9. But that move at the front end has faded in the last hour.
How much is this a bet that the ECB is going to come in and perhaps not take as much action as people are pricing in? And how much is this just basically taking a look at the fundamentals and saying things aren't changing that much? The ECB is not getting that hawkish. They're just talking about inflation as being a concern.
Worth remembering also that the ECB is in, and that they're still doing QE, and so is the
Fed.
So is the Federal Reserve. So hard to get your mind around all this. Futures up 12 on the S&P, up 1/4%. A nice lift on the Nasdaq 100, up 0.4%. Yields behave on 10s, 191.40. Crude down 0.8%, 91.56.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Another important week coming up with CPI this Thursday with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures with a lift here of 52 on the Nasdaq 100, up 1/3% on the S&P, up 1/4%. The drama in the bond market calms down a bit in Italy and a bit in the United States as well after the moves we saw on Friday. 191.40, Tom, on 10s, on 2s, just short of 130 in America, 129.
You know, John, we've got the advantage of the Bloomberg Terminal, a lot of red and green blinking lights here, but I'm sorry, I just got a 93 print on Brent crude, and I'm watching that real yield negative 0.5038. Things are ebbing and flowing here with an equity lift.
93 on Brent, 91 on WCI, and anyone waking up worried about what's happening in Italy, we've seen a massive move at the front end of the Italian bond market. BTP selling off, yields higher by 5 basis points. They were higher than that on 2s. On 10, still up by 10 basis points, Tom, so still a lift here and building on the work we put in last week.
Now, it's interesting to see. Right now, we're going to get a clinic here. Every house is different. HSBC has a unique responsibility with the London and Hong Kong heritage. Stephen King and Janet Henry riding her there over. Just a wonderful, interesting look in equities, bonds, currencies, commodities. Janet Henry, their global chief economist, joins to synthesize this morning. Janet, I want to go to the idea that inflation is elevated and it's going to come down. Do you have a framework that it reversed to something we knew, or is there a new higher level of inflation we need to get used to?
I think it comes down, but I don't think it goes back to pre-pandemic rates. So not in that sense fully transitory. But it's not just about when it comes down or how much it comes down. It's what happens in between and how much policy tightening actually has to be delivered in order to bring it back down. And that's, for instance, what you saw on the Bank of England, wasn't it? Where you had 4 members voting for 50 basis points, 5 members voting for 25, the 4 members took the view that you needed to bring it down more swiftly to prevent it becoming more of a, I suppose, a wage price dynamic, and they were prepared to take the growth consequences by voting for a more aggressive response at an earlier stage.
I would suggest, Janet, across finance and investment, there's going to be a lot of discussion in your world of where the new neutral rate is. Do you, or critically PhDs at the Fed, BOE, ECB, et cetera, does anybody have a clue at this point where the new neutral rate is?
I'm sure people have lots of thoughts, but there is just so much uncertainty about the pandemic itself and about some of the changing behavior in labor markets, how permanent it is. We're all trying to get to grips with what the structural influence of energy transition costs are, and indeed the longer term implications of this breadth of central bank mandates that we now have, and some of the inflation risk premium that might be associated with that if central banks are increasingly focusing not just on labor markets, but financial stability and income inequality and climate change itself. So no, in terms of the long-term neutral rate, I don't think anyone has a firm handle on where it is. And a lot of it really comes down to where do you see long-term potential growth? Do you think, as a consequence of the pandemic, that long-term potential growth has risen, or has it fallen? And if so, how much has it fallen? Ultimately, that will contribute to what is the long-term neutral rate.
Janet, you're speaking against a lot of the hawkishness where everyone's trying to out-hawk each other right now on the street, talking about how the new normal will be very different from the old normal. And I think about your colleague, Steve Major, who has, I believe, still a 1.5% target for the Treasury yield, 10-year Treasury, by year end. Can you talk a little bit about why negative real rates will not necessarily disappear so quickly as a lot of people think?
Well, they can in the short term, but they might not over the longer term. And I think this is where we are at the moment. You know, if you think about policy rates, when central banks set policy rates, they're thinking, how will this influence really demand? You know, that's what central banks do. They try to iron out periods of cyclical weakness or cyclical strength to bring it in line with where they see the potential supply of the economy. Now, where they see the potential supply right now in a world of extreme bottlenecks, and indeed some of these relate to energy, some of these relate to labor markets, is that going to be more persistent, or will we, once the pandemic has eased, actually, and maybe people have used up their financial cushion, whether that's from government handouts or indeed whether that's from Bitcoin trading and such like, if that fiscal cushion has come back, will we see actually people return to the labor market? And I think this is the issue about the long-term supply issues might be quite different to what we face currently. The current picture is actually, in the short term, demand has been stronger than expected, the supply constraints have been worse than expected, and monetary conditions are too loose. And therefore, do we need, just in the very short term, slightly more aggressive tightening? We think the Bank of England will be done in August, if not before, in terms of policy rate tightening. It doesn't mean that the long-term terminal rate is necessarily higher. It just means, given the looseness of monetary conditions, they need to get there a little bit more quickly.
Janet, what would you have to see to think that inflation's a bit more entrenched than what you're describing?
Well, I think I would need to see, when you say entrenched, I think we're getting back to what period. And increasingly, if inflation does continue to build and wages respond to it, the question will be, do central banks play catch up? Are they willing to accept a much sharper downturn in growth, possibly even something worse than a slowdown in growth? We know that a lot of tightening cycles typically end in some kind of contraction in GDP, or do they sit back and still take it too gradually and you see the wage pressures start to build? And I think the risks are that the Fed does have to move a bit more aggressively than the ECB. I think the ECB has got a bit more time on its hands, and arguably the market's already pricing in too much in the near term in terms of interest rate rises to have to play catch up regarding bringing monetary conditions back in line with what needs to happen to lower inflation.
Janet, with immense respect, and we're thrilled you're with us today, I want to stop the show and I want to ask you something inside baseball. And folks, this is for Global Wall Street, listening on radio, listening on television. And I think back to Steve Roach and the way he built Morgan Stanley Economics and all of their research capability. And you've done the same thing with Stephen King at HSBC. I want you to explain how you at HSBC Economics synthesize the fixed income call of Steve Major over in Hong Kong. I think for our Global Wall Street audience, this is of critical importance to talk about how a given house has such interesting research, not controversial, but just so thought-provoking as Major looks for lower rates. Talk about that.
Well, we discuss everything about the global economy, and I don't pretend to tell any fixed income strategists how bond markets work. But we know at the moment when we're moving into a world where we're getting differing rates of rate increases coming through from central banks, and also talking quite calmly about the rate with which they're willing to scale back their balance sheets in this world, as much as I suppose many of us try to assume a certain degree of science with which this works, even the most qualified economists in academic circles and indeed in central banks have a different view on how that increase in rates and that shrinkage of the balance sheet is actually going to operate. I suppose as a house, we do not subscribe to the view that actually shrinking the balance sheet at the same time as raising interest rates is necessarily going to be successful at pushing up long-term interest rates. The fact is, if we do see a lot of monetary tightening, it wouldn't be unusual to see the yield curve reach some kind of inversion.
Janet, awesome. As always, thanks for being with us. Janet Henry there of HSBC. Just going through some of the scenarios for the year ahead and how difficult it is to draw conclusions. I've spoken to three people, Tom, big money managers. Rick Reeder at BlackRock. Yeah. Heard from him. I've heard from Mark Kiesel at PIMCO. Bob Michael at JP Morgan Asset Management. The one thing all three of them have in common right now, they're carrying more cash into 22.
Yeah. So that was absolutely brilliant by Janet Henry, folks. And what's so important there, John, in Ira Jersey's written about this at Bloomberg, this linkage and the dynamics between balance sheet dynamics and higher rate dynamics is a complete original mystery.
The balance sheet reduction piece of this, Lisa, no one can really agree on how big it will be and how much it will achieve and what it will achieve.
Yeah, I mean, honestly, the fact that they're still expanding their balance sheets right now and we're talking about how much, and we're all trying to get out ahead of ourselves saying how much it could potentially be reduced. I go to Morgan Stanley's Andrew Sheets, though, saying $2 trillion combined for the four major developed market banks, that they're going to reduce their collective balance sheets by that much by the middle of 2023. The implications of that are really hard to know, especially if you have this backdrop of still a glut of liquidity and still growth.
And so many people just think they can't achieve it.
Well, don't they? I mean, this is the heart of the matter, folks. And John and Lisa, wouldn't you agree the number one way to solve that is to go longer, x-axis out?
Well, sure. I mean, that's why a lot of people are actually looking to hold for longer and try to get a better sense of this. But the problem here is that the path there, it matters a lot in terms of what you want to own. And I think, John, honestly, looking at people already forecasting going back into tech in the second half of the year, how long does it take?
It's cute, isn't it?
How long does it take before we get the slowdown and enough data to say, okay, we're no longer worried about inflation for that to happen?
I'm not saying it's wrong. I'm just saying it's cute to separate the year that way. Maybe too cute, but you can see why people are making that call. Just this idea that growth starts to slow and the growth scare becomes the bigger fear. And therefore, if you're going to be allocated to equities, that's where you want to be. But there's so much of this year still to go. I mean, we closed out last year. Where were we on the 2-year in America? And how much have we done in just a month
John,
or so?
You know, I lose track of where we are. I believe it's the first week of February. It feels like the fourth week of April. I mean, to be honest.
No, Tom, I'm with you. It does feel that way. And the one thing that I keep going back to that these central banks do have on their side to some degree, I think the calendar is on their side for this year, just in terms of the base effects.
John,
just in terms of the base effects.
I hate to say this, but Abramowitz nailed this in her column this week. And this word tantrum is the emotion that everybody fears.
Catch Bramo's column on Bloomberg.com.
Connection lost.
And on the Bloomberg terminal. We're going to keep pushing this, Lisa.
Thank you. That's very sweet.
Published every Sunday.
Well, coming up on the Open, Michael Purvis is joining you.
There we go. Of Tallback and Capital Advisors.
Very nice.
Isn't that nice, TK?
Just so
just
much
that
love.
partnership. It's just beautiful.
But it's not,
Were you going to sing then? You are singing.
I think he is singing.
I'm
You are
singing the
singing.
Australian national anthem for
Okay.
their curling victories.
Okay, just don't do your curling
And
impression
something else.
ever again.
Skiing, moguls.
New York.
You should see me in the moguls.
I broke my sternum on moguls a long time ago. Brutal. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden's top advisors are repackaging his economic message to the American public. That comes at a time when his approval ratings are sinking and his legislative agenda stalls in Congress. In the last week, the president has put more emphasis on growth in wages, union jobs, and domestic manufacturing. He's giving less weight to areas that are sore points with voters, such as inflation and the partisan strife over COVID. A member of the European Central Bank's Governing Council sees an interest rate hike as early as October. Klaas Knot told Dutch TV that a 25 basis point increase is likely. Knot said a second rate hike can then take place in the spring of 2023. He's considered one of the ECB's most hawkish officials. The pandemic and China's restrictions to control it are damaging domestic spending, travel and consumption during the just-ended Lunar New Year break was down from 2021's already low level. People in China made 251 million trips during the 7-day holiday. That's down 2% from last year and a 26% drop from 2019. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. meeting is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
We're still working to discourage the Russians from making the wrong choice of choosing confrontation. We will continue to work on a diplomatic solution, but at the same time, we know that the Russians continue to prepare, and we will be working to address the security issues.
With Jake Tapper over at CNN, the ambassador of the United States to the United Nations, Linda Thomas Greenfield there managing the message for her. Right now, Angela Stent joins us. She is well-known resident senior fellow at Brookings, holds court at Georgetown as well, but far more is our definitive voice on Mr. Putin. Her book of a number of years ago was absolutely definitive on reframing the early Putin to the later Putin. And right now, with the Putin Doctrine in Foreign Affairs magazine, she holds the high ground and on our analysis of this moment. Dr. Stent, thank you so much for joining us this morning. I want to talk about a single sentence in your The Putin Doctrine. This is his fifth president. I found that extraordinary. Explain to me the importance of the Putin longevity and that Mr. Biden is his fifth president.
Well, thank you very much for having me on. So, you know, Putin sat in the Kremlin. He's seen these U.S. presidents come and go. He's become quite cynical about everything. He hasn't been very impressed by a lot of these presidents. And he's now at the point where he looks at the U.S. We obviously have our domestic political troubles. He throws down the gauntlet, these two ultimatums at the U.S. and NATO, and we are essentially dancing to his tune. We're responding to his agenda. You have a flurry of diplomatic activity going on all the time, and he's sitting there watching us essentially scramble to try and avoid, obviously, a major war in Europe.
Angela Stent, you brilliantly review the three choices here. We're all very familiar with the collapse of the Soviet Union. I think Lisa's got some important questions on that. But you go back, you have the courage to go back to Yalta and to say there was a tripolar outcome of the Yalta system. Explain what a shock that would be to America to see Russia, China, and America with their own parts of this world.
So Yalta is Putin's model. He has praised it all the time. And now, and we've just seen Putin and Xi Jinping together in Beijing talking about a new world order. This would be a shock. We thought we had ended this kind of system with two spheres of influence and domination by the great powers of the smaller powers. And this is precisely what Putin would like to restore. And the Chinese, of course, would get their sphere of influence. And if you ask the Japanese or the Koreans or a number of other countries how they would feel about that, you can imagine what they would say. And certainly the Central and East European countries do not want to go back to being in a Russian sphere of influence.
Angela, how close are the allies in terms of coordinating to try to counteract exactly the outcome that Vladimir Putin is looking for?
So the Biden administration, I think, has done very well trying to coordinate things. We have the German chancellor in Washington today talking to President Biden, hoping again to get him on board with, say, tough sanctions, including energy sanctions, if there is to be a war there. President Macron is in Moscow today trying to talk Putin down. Apparently, he is in close contact with the White House. So I think the coordination is pretty good. But of course, there are differences of interest between different European countries and the U.S., particularly, again, if you think about sanctions.
Angela, is Vladimir Putin winning?
Well, at the moment, he looks as if he is, because There's been no de-escalation. In fact, there's more escalation. We read today 70% of the troops that would be needed for an invasion are already amassed on the border. And we are all running around, again, trying to find a solution to this. And he has China's back. He and Xi Jinping had put out this extraordinary statement in Beijing on Friday, where they and China will support Russia in whatever it does. So it looks as if he's winning.
This is concerning considering the fact that your concluding paragraph of your essay was that Putin's overarching aim is reversing the consequences of the Soviet collapse, as we were talking about, splitting the transatlantic alliance, which sounds like it still is relatively firm, and renegotiating the geographic settlement that ended the Cold War. Can you game out what type of altercation would sort of lead to his goals being achieved?
So I think it's highly unlikely that he will achieve the goals of NATO, saying that we'll never enlarge, and essentially handing him back a sphere of influence, including in countries like Poland, because he has said that NATO should retreat to where it was in 1997. If there is a major incursion, obviously this would be terribly destructive for Europe, but it's very hard to see that ending in giving him what he wants. We do have an alliance of 30 countries, NATO, and we would resist that.
Are we at a point of negotiation now? I mean, the diplomacy is us talking to ourselves and maybe Mr. Putin talking to himself or the guy over in China as well. Is there any dialogue actually going on now? I don't sense it.
Well, there is dialogue going on, and, we have responded to the Soviet demands, and we've said, we, the US and NATO, let's talk about missile defense. Let's talk about troop deployments in Europe. Let's talk about other ways in which we can build, rebuild confidence. Let's revitalize the NATO-Russia Council. So we have made all these proposals. The Russians have responded to them. That was, leaked the other day to El País. And there are conversations going on, and there are dialogues between the U.S. and Russia on other issues, but the diplomacy does seem to be stalling.
Angela Stent, thank you so much. Writing in Foreign Affairs, I can't say enough about the essay, The Putin Doctrine. I will put that out on Twitter as well. Just a really superb essay. Lisa, I just thought that was great. And the idea here of the back and forth and the confusion over almost the daily rhetoric we see out of different capitals, and particularly out of Washington. And, of course, the denials of Russia where they're saying, wait a minute, this is what we've said or not said. The confusion of messaging now is extraordinary.
And the New York Times report over the weekend coming out and saying that Russia had established about 70% of the troops they would need to do a full-out invasion of Ukraine. Again, they're saying that they're not going to, Russia that is, but really talking about what the goals are. Is it really just that they are concerned about Ukraine joining NATO, or is this some trying to reorder the world, which is the reason why people are focusing on Vladimir Putin meeting with Xi Jinping of China and prolonging some sort of a prolonged conflict until after the Olympics.
And again, this goes back to our arch international relations, and what we're going to try to do, folks, is bring you a lot of the different competing theories here. One thing we didn't get to there is the presumption that there was any form of upset. The refugee crisis would be substantial. I thought that was in the zeitgeist this weekend as well, Lisa.
It was, and this concern about what would happen to those people. And then, of course, there's the market story, which we heard from Christian Malek, this idea of $150 a barrel of oil, and that oil might be more affected, frankly, than even natural gas if you take the plus out of OPEC plus.
Well, it's going to be interesting to see. What we need to do is round up a data check here to get radio and television on their way into the morning. It was red on the screen earlier. There's a little bit of lift to equities. Futures up 8. The VIX not part of the story. 23.71 on the VIX. The yield curve a jumble. I'm watching the 10-year yield really moving to a lower negative rate in the last 10 minutes. Stay with us. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Looking to add to the biggest weekly gain of the year so far. From New York City this morning, good morning, good morning. Your equity market up 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
From New York, we begin with the big issue, the beginning of the end of easy money.
We definitely have a new regime underway. We're at a turning point.
There should be no ambiguity.
Monetary policy is tightening.
The environment is one of tightening policy. End of QE, beginning of QT.
We've largely priced in a more aggressive Fed.
They confirmed that tapering would end on schedule in March.
We're talking about 5 and 6 and 7 hikes.
All the talk around 50 basis points. The Fed is further and further behind, and they're going to have to catch up.
They do have a really difficult job. As the Fed and global central banks pull back,
that's going to cause some challenges.
Particularly as it relates to the bond market.
It's time for investors really to get used to this.
Joining us now is G Squared's Victoria Green, Tallbackers Michael Purvis and Colin Martin and Charles Schwab. I want to start with you, Victoria. Just how much of a regime shift is this?
Not an unexpected regime shift, and it's quite a normalization, and it's a good thing. This means the economy is going forward. I do think it's interesting now we have a 35% hike of a 50 basis point hike here in March. So obviously people are accelerating, but I really don't think it can get much more hawkish, right? I mean, we're already at 5 to 7 hikes, maybe 50 bips in March, you know, completely starting to unwind the balance sheet. I think all of that started to get priced in. And so while the Fed is definitely moving a little late, they are going to move, but the market's already pricing in an aggressive hawkish move. So I don't think it's the end of the world. Regime shifts normal. This is just part of the recovery and economic cycle. And, you know, as a person who's bullish on equities, I say bring it on.
Andrew Sheets of Morgan Stanley did not say the same thing over the weekend. He said it begins. He wrote this: from May 22 to May 23, Morgan Stanley economists expect G4 central bank balance sheets to shrink by $2 trillion, 4 times the largest 12-month decline ever from 2018 to 2019. Michael Purvis, do you agree with Victoria Green? Bring it on.
I do agree with Victoria. I think, for me, you know, so far,
the 10-year yield has been pretty range bound, and all the violence has really been, in the next couple of years. I think what will be, not friendly for equities and certainly not for the back end of the market is if a meaningful term premium is really built in. And I think that really gets to, how the markets and also the Fed consider sort of longer term inflation. And to me, that's the big riddle I'm trying to work out. Whether we get, 50 in March or 25 in March and all that, to me, from an equity perspective, I think that's more noise. I think it really comes down to what is the long-term neutral rate, where is that perceived to be settling out, and I think that's going to be a very interesting thing, and what factors are needed to take that those expectations meaningfully higher.
Yeah, the start of the journey is old news. Now it's about the destination. So let's talk about that more. Bank of America say this about the ECB. They're calling for accelerated tapering with QE ending in July, rate hikes in September and December. They say the hawks have won. January inflation lifts our 22 forecast to 4.4%, but 23 stays below 2. They say when fundamentals aren't there, hikes can't go far. Colin Martin, can I get your view on this? This is a conversation about the start. Let's talk about the destination, how far the Fed can go, how far the ECB can take things.
That's the big question that we're looking at, John. From the Fed's standpoint, unfortunately, the markets don't believe they can get too far. If you look at expectations for the terminal rate, where we look at the Fed funds rate or Eurodollars futures a few years out, they're still stuck in that 2 to 2.25% range. And unfortunately, we didn't even really see much of a rise over the past few weeks, despite still high inflation and despite such a strong jobs report on Friday. There are some good news out there, though. One thing that we're looking at is the participation rate. We saw a good jump both in the broad index and in the prime age population participation rate on Friday. That means there is more of a runway for the economy to continue to grow, for workers to rejoin the workforce, might reduce some of the pressure on wage prices we're seeing, and that will allow the Fed to maybe hike more than the markets are anticipating. We're not, changing our tune just yet. For now, it looks like they might only be able to get to that 2.25% range, but it comes down to a balancing act. If they can successfully hike rates without, popping any sort of asset class price appreciation that's out there, without disrupting the markets too much, if they can do it in a somewhat methodical way, in a somewhat patient approach, and they can maybe get above that 2.25% range, which can lift all yields a little bit higher.
Let's just sit on that graphic that we just put up on the screen of the estimates for Thursday for CPI in America. 7.3 is the median, 7 is the low, the high is 7.6. And let's bring in Michael McKee. Mike McKee, this whole street expects a 7 handle this Thursday.
Oh, we expect a little bit more than that, and maybe we get the same thing in February, but then economists think we're going to start to go down because of base effects. But here's what we're expecting Thursday, at least the medians for what we're expecting, and it is, as you say, 7.3% for the headline. For the core, it is 5.9%, and we continue to make those 1980s numbers over again. Where does it matter? Well, it does matter down in Washington. It does matter to Joe Biden and the administration. Bloomberg, a story today about how they're retooling their economic message, because what's happening is people's wages are not rising as fast as inflation, and we will get that data on Thursday as well. The inflation-adjusted wage levels, as you can see, below zero, down about 2%, and that will take a bigger hit on Thursday when we get numbers like 7.3%. So there's a political implication, but so far it is not feeding over into the economic implication. A lot of lines on this chart, but basically there are 3 break-evens, 2-year, 5-year, and 10-year for investors, and there's 2 for consumers, the 1-year and 10-year Michigan numbers. And as you can see, inflation has continued to go up, but except for 1-year inflation expectations by consumers, expectations stay anchored. So the Fed isn't going to be thinking it needs to do a huge whole lot yet at this point. So we'll see what the market reaction is on Thursday. But if we don't see those numbers, those lines start to go higher, then the Fed probably stays on course for 25 basis points and a couple, maybe 4 or 5 rate increases this year if inflation doesn't start to go back down.
Mike McKee, thank you. Still trying to game this out, trying to game it all out. Victoria Green, I want to come to you on small caps. Where small caps fit into the conversation for you, given this broader debate about inflation?
Yeah, and small caps have taken a beating here in January and February. They're down about as much as the Russell, the NASDAQ, they're down about 10%. I think small caps have a lot of potential because they have a potentially faster growth rate. So as we think that maybe large caps may moderate and slow growth, which quite frankly, earnings have been fantastic across the board. You've seen solid EPS beats, solid margin beats. You know, people are printing money here in these companies. We think small caps may be an area that's undervalued. They've certainly taken a beating the last 90 days. And I think that's an area that if we think the economy might be slowing down and we want to be looking for areas with better growth potential, small caps are certainly an area you could look at that might be able to pick up that growth. But these companies are still companies we hope have good earnings. We're not buying the future earnings, the non-cash flow companies. We still like good companies, just maybe at a lower multiple and a little bit higher upside.
Michael Purvis just got this note from Bank of America. Ethan and Savita will be holding a strategy call at the top of the next hour. Just a line from them, a snippet. The key risk to stocks from a Fed hiking cycle, the Fed's hiking into an overvalued market. It ended poorly at 99. Why is it different this time around? Michael Purvis, what's your reaction to that?
Well, John, I think, when we came into this year, you saw the NASDAQ, the NDX, really lead this sort of volatility in the market dip lower. There was good reasons for that, which is that you had very high P expansion in large cap tech into a rate move, right? I mean, you can have P expansion and you can have a rate move, but for the NASDAQ, which has a not very understandable rate sensitivity, you sort of can't have both. And so what happened during January was there was sort of a recognition that the equity risk premium for the NASDAQ was overly compressed and it needed to reset there. So look, I think for me, it's a little bit more nuanced. I think as we look at equities, to me, I look at, I try to get some sense for where the 10-year is likely to trade, and I try to get some sense of what equity risk premium should be layered on top of that to arrive at what is a fair valuation.
Yeah.
So I think by no stretch do I think the NASDAQ is in a super bearish position. I do think it's got some more work to cut out in terms of sort of reaffirming what we just learned, that big cap tech is continuing to generate earnings. But for the broader market and the more cyclical parts of the equity complex, I think you're going to continue to see very good, to Victoria's point, very good, robust earnings growth here that's going to reinforce, a very healthy equity risk premium and allow dips to continue to be bought.
I need a better sense of what's happening in the corporate credit market, Colin Martin. When you look at the equity market, it's clear that things have calmed down a bit. Look at the direction of the VIX and volatility. You can get a decent sense of that. Colin, I don't see the same thing in credit. I've heard from a lot of people who are talking about that. Just the cost of protecting losses, what's happening with CDS in Europe and in the United States as well. There seems to be a little bit of a gap emerging here, Colin, between what's happening in corporate credit and what's happening in equities. And I'm wondering how that gap is going to reconcile.
We are seeing that gap. We're seeing credit spreads rise pretty much everywhere, whether it's investment grade or high yield. We're seeing the cost of borrowing increase. We're seeing corporate bonds, any credit rating down pretty sharply for the year. That's what happens when the Fed begins to pull back its easy monetary policies, and that's what happens when the tide rolls out. We expect more volatility. The cost of borrowing goes up. We're not necessarily ringing the alarm bells just yet. We do think volatility will remain elevated in the credit markets this year, especially the junk markets, but we're not expecting necessarily a surge in spreads. But when you look at some of the recent price action and spread action, high yield spreads and yields, the yield was below 4% in the middle of last year, but you can get close to 3% on an investment grade corporate bond index today. So you can get similar yield without taking as much risk. But at some point, as high yield spreads rise and that yield rises, we think there'll be demand there. The average yield of the high yield index is around 5.5% right now. If it keeps rising a little bit, say 6.5%, there should be demand there because fundamentals are relatively strong. Corporate profits are at record highs. Corporations have a lot of liquid assets on their balance sheet. And again, if those yields do rise a little bit, we think there would be some demand there. So we expect more volatility. We do have more of a cautious tilt out there on the riskier parts of the market, but we're not saying investors need to get out just yet.
Colin, stick with us alongside Michael Purvis and Victoria Green. Your equity market's positive 0.2 on the S&P with some movers going into the opening bell. Here's Abby.
John, well, it is Monday, and we do have some Monday M&A action. Starting out with the shares of Peloton, it is possible takeover action that has these shares absolutely soaring. Earlier, up more than 30%, now up 27%, not so shabby. On the news that the company is open to takeover activity, according to confidential sources, private sources. They're working with an advisor. Now, there is a 12% short interest on this stock, so it could be a bit of a short squeeze. But considering that the stock is down about 85% from its peak, 20% below its 2019 IPO price, you can bet that longs are probably pretty happy about this news, too. Spirit Airlines up 12% on the news that Frontier is buying them for $2.9 billion in a cash and stock deal. Plus, they reported a much narrower loss than expected. For Frontier, this is to beef up their services versus the big carriers. Some big movers on this Monday, John.
Abby, thank you. As always, thank you very much. Abby, through the show, breaking down some of the stock movers for us. Coming up, Western leaders continuing their push to prevent aggression against Ukraine.
Now we are not alone, and we think that this year we can combat all possible situations.
That conversation coming up next.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
There's a real danger for a Russian invasion, but that makes it even more important to also look for a political way forward.
Diplomatic efforts heating up, hoping to de-escalate the tensions surrounding Ukraine. German leader Olaf Scholz meeting President Biden in D.C. as France heads to Russia in hopes of finding a middle ground. A Kremlin spokesman saying the following. Macron has told Putin he's coming with certain ideas for possible ways to reduce tensions in Europe. Russia has repeatedly, publicly denied any plan to attack Ukraine. Bloomberg's AMH and Maria Tadeo joins us now for more. AMH, let's begin with you. An important conversation a little bit later with the president and the German leader.
Certainly important. And John, we have already seen the diplomacy between Berlin and Washington take hold, especially when it comes to a harsh sanctions package. The most revealing comment for me so far in this whole crisis of trying to get this sanctions package over the line between the Western allies was from Olaf Scholz a few weeks ago. And he said we need to be prudent and no one should be under any guise that these sanctions we're going to put on Russia will not hurt us. And it's really, for me, Jonathan, going to come down, I imagine, to Nord Stream 2, because that is a political hot potato between Republicans and Democrats right here in Washington, D.C. And over the weekend, Jake Sullivan, the president's national security advisor, directly said if there was a further invasion of Ukraine from Russia, there would be no longer a movement towards operating Nord Stream 2. When you ask Olaf Scholz that same question, he just says all options are on the table.
Chancellor Scholz has got to tell us today what he stands for. This is a big moment for him. Mr. Macron, President Macron heads to Moscow. Maria, what's on the table for him?
Well, Emmanuel Macron always has many ideas, and the same goes for French diplomacy. But the question is, how much can they turn into reality? Now, going into this trip in Moscow, Emmanuel Macron said, of course, that Russia is, quote, a great nation. Its people are great people. But, of course, the security of Europe cannot be sacrificed for Vladimir Putin. Now, the question here is, what can he actually tell Vladimir Putin that we've not heard before and can actually lead to a de-escalation? Just to give you some color, though, we know that in this meeting room, it will be just the French president, Vladimir Putin, and their translators. That makes officials nervous in Brussels. It also makes them nervous in D.C. Sometimes we know that Emmanuel Macron has this capacity to go off script, to go off remarks that were not planned. But I do have to say the French have been on the phone with virtually every leader of the Western world, including Prime Minister Boris Johnson and President Biden. The idea here is that he wants to send a united message, but I'd be very keen to find out what happens in this meeting after the two meet in private. Again, it's just the two of them and their translators. And of course, to see that reaction from the Kremlin, which, by the way, they're already saying we're not really expecting a breakthrough, because the reality is, Jonathan, the only bilateral relationship the Russians care about is the United States. They have the money, they have the weapons.
Looking forward to the coverage from both of you. Maria Tadeo out of Brussels, and to the birthday girl outside of the White House, Anne-Marie Horden. I'm not going to let it go, Anne-Marie. Just so many happy birthdays. And we're going to see you again later this hour. AMH, thank you. I believe they've killed your mic, so you can't get back at me either. The team over at UBS warning investors about overlooking conflict risk. They say the following: little or no Russia-Ukraine risk appears to be priced in. If the situation gets bad, be prepared to reduce risk. Let me come to you on that, Victoria Green. I have no idea what any of this really means. When you say it's not priced in, where should it be priced in?
I don't think it should be priced in. If you look back at a history of conflicts and how the market has reacted to it, anything from World War II to 9/11, historically it's a pullback. It can be aggressive, but then it snaps back fairly quickly. And I look at this more as a saber rattling and aggression, and Putin kind of throwing his weight around. I do understand, obviously, coming this way during the winter, natural gas and some of their commodities are what they're going to push around, and that does have a big effect on Europe. It'd be very hard for us to pick up, even with the, you've got your Cheniers and your Sabine Pass, and we're exporting LNG. Gas has Europe by the throat, and that's a difficult place to be in, and that's one of the levers he's going to pull to try to get his way. But historically, I've always invested to what is probable, not what is possible. And so there's a range of possibilities here, from full-blown invasion to just saber rattling to cyber warfare and skirmishes, but not a real huge shooting war. And so I think what is highly probable is that this gets resolved without this devolving into World War III. And so in that regard, I look at the market and say, I don't think it really needs to price in much more, because I don't think it's going to be this massive years-long effect.
Michael Purvis, your thoughts on this? If there's a risk here, where should it be priced?
Well, it's a very interesting question, and I hear what Victoria's saying, that you need to focus on the probable. Still, if you want to hedge the possible, do you want to buy S&P puts, or do you want to buy get long oil or natural gas proxy? I would be inclined towards the latter here, because I think Victoria's right. The U.S. equity complex has an amazing ability to be sort of see through this. If you remember back when Crimea was when Putin was moving into Crimea a few years ago, the VIX went from 14 to 15 for about a day or so. Now, this is a different situation. If we do go if, God forbid, we do go into a hot situation in Ukraine, it will be very interesting. But again, I think the more obvious thing to do would be to get something where oil or natural gas or even food prices are then really you see some jumps there. I think it's just better risk return. One other comment I just make on it, which is that again, to Victoria's point on markets seeing through geopolitical tensions, if you look at Taiwan and China, really over the last 6 months, if you look at Korean won balls, those have been incredibly low, sort of ignoring that whole thing. It's been an interesting discussion for people that focus on geopolitics, but from a sort of cross-asset markets point of view, you're really not seeing tension being built into that situation either.
And Colin, just a final word from you, please.
I'd agree with both of the guests. If you look at just the bond market, there's really very little sense that the markets are reacting to anything overseas with the Russia-Ukraine situation. If you look at the treasury market or the credit markets, it's driven almost exclusively by the U.S. economic data and what that means for Fed policy. Now, if something were to happen where there was a bigger event and the situation deteriorated a little bit, I wouldn't be surprised if we saw long-term treasury yields come down a little bit, if there was a risk-off environment, a little bit of a flight for safety. But at the end of the day, I think Fed policy, domestic economic fundamentals are really what's going to be driving the market right now. And I think the Fed is likely to raise rates in March. It's likely to steadily increase rates for the remainder of the year. Yeah. And I think there's very little that would prevent that from happening.
Colin Marnard sticking with us alongside Michael Purvis and Victoria Green. Coming up in the morning calls and later, some of the biggest single-name stock market cap swings we've ever seen. More on that next. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Messy morning in the European debt market. In the US equity market so far, things are okay. Futures settled down, up a little more than 0.1% on the S&P, up 0.2 on the Nasdaq. That's the equity price action a few minutes away from the opening bell. Here are your morning calls. First up, Bank of America downgrading Southern Company to neutral, seeing a more balanced risk-reward following the stock's recent outperformance. We're down there 1.7%. Argus upgrading Hershey to a buy, highlighting management's focus on shareholder returns and dividend payments. That stock is up 1%. Citi downgrading Stanley Black & Decker to a sell from a buy, seeing rising risk for the company's upcoming earnings. We're negative there 3%. They are your morning calls. Coming up, strategists divided on Wall Street. JP Morgan making the case for stocks as Morgan Stanley wants a further downside. Your equity market's doing okay, positive on the S&P going into the opening bell from New York. Your cash open is next.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
A global synchronized timing cycle might be upon us. We've got to figure that out, what it means for this equity market. For last week, the biggest weekly gain on the S&P of the year so far. We add to it just a little bit, up 6 points on the S&P, up a little more than 1/10 of 1%. On the NASDAQ, up a little more than 1/10 of 1% going into your opening bell. That is your opening bell. Switch at the board and get to the bond market. 2-year yields through 130 over the last couple of days, through 190 on 10s. That sticks. 192, 191, 95 on 10s, up a single basis point. In Italy, at the front end on a 2-year, 50 basis points higher in 6 sessions. We've got to talk about that through the morning right here on Bloomberg TV. I know Guy Johnson laser focused on it. Euro dollar 114.26 with negative 0.2 of 1% on that currency pair. Just bear in mind this, even the most hawkish policymaker on the Governing Council right now is only thinking about a 25 basis point hike in Q4 and another one in spring. Things can change, but that's where the likes of Klaus Knott is right now. Crude at 91.50, negative 0.9 of 1%. We pull back on WTI and on Brent as well. We caught up with RBC's Laurie Calvasina a little bit earlier this morning, weighing in on the results so far this earnings season.
It seems to me like it's going to be a messy quarter. Now, we haven't really seen companies, sit here and say things are a disaster, right? Like if you look at the consumer in particular, people are being vigilant. They're watching the low end. But I would say that the confidence level does seem to me a little bit shakier than what we've seen, sort of the past few quarters.
Back with us, Victoria Green, Michael Purvis, Colin Martin. Victoria, where's the confidence come from going into an earnings print where a mega cap can move 20% either way off the back of it? Where do you get the confidence from that?
I think you have to have confidence in your underlying companies. Last year, a rising tide lifted all boats, right? You could almost like throw a dart at the dartboard and companies were making money. This year, it's going to matter who your management team is, what the cash flows is, how they've managed labor and inflationary costs. And so I think this is a good year to be active, a little less into passive indexes, because I think it's going to really matter what you own. If you look at the dichotomy of just automakers, and I know it's not apple to apples, but what Tesla did versus what Ford did, or what Snap did versus and Twitter did versus what Facebook did, instead of being able to say all auto companies or all social media companies, you're having to actually look around and say, okay, who is the best run company, or who has the best growth prospects, who's managing during an inflationary period better. Because the chip shortage didn't hit everybody equally. The labor inflation costs didn't hit everybody equally. And so you have better companies managing this crisis and managing through a different cycle. And so I think it really, really matters. And I'm not surprised. It's kind of nice to see it where the fangs of the world just outperform everybody. It is going to matter which ones you own. And obviously Google and Amazon and Apple, they were absolutely stellar. I mean, it's hard to bet against them, but at the same point, you had your reminders with Netflix and Facebook. You got to watch those valuations, and you got to feel comfortable in the company's growth prospects going forward. I think it's funny because it no longer matters. What did you do for me last year? All we care about is what are you going to do for me now?
And next year and the year after. Michael Purvis, to Victoria's point, it's not just about sectors versus sectors within sectors. Massive winners, massive losers. A lot of people come in to any given year and say the same thing. Mike, they'll say it's the year of stock picking, the world of active management. Things have moved on from passive. We're saying it again, Michael, but is this time different?
Look, I think there is, as we're getting further into this cycle, there will be, a lot more nuances there. On Facebook, I do kind of wonder whether that massive miss, Facebook bears have been waiting for that for 3 or 4 years now, right? I mean, there's been, it finally seems to have caught up with it. And I don't know if I don't think it's in any respect some sort of indication of any economic condition. I would make one other point here, which is that, in terms of the broader issue of do you want to allocate to equities in the United States this year or not, it's important to recognize that at least so far, we're a little more than halfway through the earnings season, and certainly a lot of the most prominent names have come, and the revenue beats are more impressive than they were in Q3, and Q3 revenue beats were really quite impressive as well. Earning beats are also quite robust, not quite as robust as the revenue beats. So I think it does sort of, I think, reinforce this notion that we're looking at very robust nominal GDP this year, and obviously, stock picking is important, but I think to think that we're not going to continue to see at the index level very impressive earnings growth this year, even with some margin compression in certain stocks and sectors. I think that's going to be, that's a hard bet to make. I think I'm very constructive on earnings this year and into next year. And I think it's also important to recognize that some of these supply chain issues, as it relates to companies like Ford and so forth, they really do also help reinforce sort of a higher floor of earnings over the next 2 to 3 years as well.
There's a ton of way of viewing this market. Here's two: Morgan Stanley versus JP Morgan. I think they're just the two worlds right now. Morgan Stanley and Mike Wilson say this: we think the first half of this year could see beat rates fall below zero. This is on earnings. The companies with the greatest earnings risk remain those businesses that benefited from the pandemic pull forward the most. JP Morgan and Mislav Mateka say this: it's wrong to position for a recession given still extremely favorable financing conditions. We look for more gains in earnings, bottoming out in China activity, and expect the Fed not to turn ever more hawkish. Colin Martin, can I come to you on those last two lines there? A bottoming out in China activity and expecting the Fed not to turn ever more hawkish. Just whether those so-called headwinds might develop into being somewhat, at least relatively speaking, tailwinds.
They could be. When you look at China, they've eased a little bit right now. They've made a lot of headlines with the high yield real estate sector and the impacts and the spillover effects there. If there is more easing there, more government support, that could become a tailwind. The Fed, though, that's front and center. If they don't turn more hawkish, that would be a good thing for all risk assets. But going back to a lot of the points that the previous guest made, when we look at the credit markets, I think it will be there will be some more winners and losers going forward as opposed to just winners. And we look back to 2020, the Fed's credit facilities and super easy monetary policies, were the definition of a rising tide lifts all boats. And then we moved into 2021, economic growth was still very, very strong. Monetary policy was still easy and corporate profits continued to grow. It was really, really great for credit fundamentals. But now as we're in 2022, we have the Fed moving to tightening. We have supply chain bottlenecks that are still out there. They seem to be improving, but they're not gone. And that's a risk for junky, high yield companies who have very thin margins and rely on cash flows. And if there's a delay there, that's a risk. And then inflation, of course, if they can't pass on those price gains to consumers, that eats into their profit margins as well. So we are getting a little bit more cautious there. We see the greatest risk in the triple Cs, the lowest rated of the junk. They just have less wiggle room as the Fed does continue to tighten and as we do see a shift from easy to what will be described as tight financial conditions.
7 minutes into this session, equities advanced just 0.03% on the S&P. Top of the pile, consumer discretionary up 0.7%. At the bottom, energy negative a little more than 1%. We'll return to that energy story in just a moment. Tons of volatility to start the year. Let's get to Katie Lights for more. Hey, Kaylee.
Hey, John. Well, it has been a really wild couple of weeks. I just took a look at the last 14 trading days, so about 3 trading weeks or so. The S&P 500 has moved to the up or downside by at least 1% in 8 of those, so more than half. And for the NASDAQ 100, 10 of the last 14 days have seen a move to the up or downside by 1% or more. And that is just at the closing level, John. That doesn't even go as far as to tell us about the intraday volatility we've experienced with some of the biggest intraday swings going all the way back to 2008. And the thing about it is this volatility isn't limited to penny stocks or lower valuation companies. It has hit the largest companies out there, including mega caps, Amazon and Facebook, which on back-to-back days posted the largest ever one-day market cap loss and one-day market cap gain in U.S. market history. Values literally altered by hundreds of billions of dollars. What's interesting, though, John, is amid all of this, we have actually seen equity volatility begin to retreat. The VIX, which gauges the expected swings on the S&P 500, and the VXN, which is the equivalent gauge for the NASDAQ, did reach their highest level in about a year on January 26th, but things have calmed down since. What hasn't calmed down is the volatility in the bond market, with the MOVE index continuing to move higher and higher, John.
Katie Lights, thank you very much. The volatility, a story to watch, and that story that Victoria Green mentioned, just the divergence, the differentiation between certain sectors within the FANG trade as well. Let's get to Abby for that. Hey, Abby.
Hey, John. Yeah, this is super interesting. There's definitely a tale of 2 stories among the big mega cap tech names this year, and it shows in terms of performance. Now, back in 2020, all of these names, your Amazons, Apples, Facebooks, and so on and so forth, all higher, going the same way. But more recently, it's been Apple and Alphabet to climb higher in yellow and blue. And then, of course, you have Meta Platforms, Netflix, and Amazon going in the wrong direction. So that's a big, big divergence there. Another divergence within the FANG complex that some people may not be aware of, 20% of the New York, the NYSE FANG index, it is China tech ADR representation. You can see today Alibaba is down 5.7%, Baidu about flat. But of course, last year, China tech down in a huge way. So that's another piece of the story. But the big story relative to earnings, it's interesting, John, outside of Facebook, all of these companies have beat. Of course, Meta Platforms, they've missed in a big way. But you can see that Tesla and Meta Platforms, after the big earnings reactions, down 12%, then down 26%. Amazon, of course, into its earnings, that surprise to the upside had been down, but then a positive reaction. But big, big reactions, and there does seem to be a massive divergence within the complex, John.
Abby, just unreal. In fact, ridiculous. Can we put that graphic back up on the screen and just leave it there just for a moment, just to take it all in? And Michael Purvis, I want to come to you on some of these numbers. The single-day stock market reaction of an Amazon, of a Facebook, of a Tesla, of an Alphabet, these are monster companies. And never mind the EPS beat and miss, I'd just love to see the market cap gains and losses off the back of this too. Michael, what have you taken away from these wild swings from mega cap stocks?
Well, I don't rush to come up with sort of a fundamental narrative there. Look, I mean, if Amazon's going to be revalued higher or Facebook lower, that's sort of, sort of standard operating procedure off better or poor earnings things. I do think it's an interesting comment just on market structure and sort of the growing use of options and the amount of options relative to cash volumes. I think there's a lot of that creates this enormous things. As your colleague was just addressing, like there's been a huge divergence in close-to-close volatility relative at the SPX level relative to intraday volatility in the SPX over the last 3 weeks has been at record highs, multi-year highs, much more so than the close-to-close volatility. And that's really partly a reflection of this earnings price reaction, which I think is also tied to market structure issues, certainly. And let's not forget that a lot of these stocks have been such fantastic winners for so long that people, when Facebook comes in with zero growth in its core business, that's going to get a big reaction.
Information technology doing okay this morning, up 0.4%, about 12 minutes in. The S&P up 0.2%. The underperformance coming from energy. And Victoria, I promised some time with you on that, and I want to do that with you just to wrap up the conversation. Energy's down 0.6%. These stocks have been so hot. Why do you think that this run can continue?
I don't see oil prices going down anytime soon. I think we're in a period of supply and demand crunch, and I think supplies are OPEC Plus can't even meet their 400,000 barrel output because of what's happening in Libya. Maybe Iran comes on, there's tons of things, the what if game, but I honestly think the oil market's a great place to be. Number one, cyclical commodities are a fantastic way to offset inflation. Number two, a lot of these oil companies are massive cash cows. You're not seeing the old wildcatter days where they're plowing all their earnings back in and suddenly the rig count's exploding. No, it's not. The rig count's at 613. We're still well below pandemic highs and much lower than the 2014 highs. So if you look at supply and demand, you see how these companies are reacting. You have a lot of our top picks are actively saying, please, shareholders, take our cash. Devon, EOG, Conoco, you're seeing these buybacks, you're seeing the fixed plus variable dividends. They're actively pushing cash to shareholders as a reward to sticking with them through some tough times. But honestly, I think a bigger risk is energy eventually overheats. Oil owned for 100 a barrel is not good for the consumer. It hits at the pump too hard, and generally, it eventually will drag on the economy some. But right now, if we could sit in the 70 to 90 a barrel range, a lot of the big U.S. oil producers, especially those with a great position in the Permian, their break-evens are in the 30. So they're just printing money for us.
91 right now on WTI Brent and 92.70. Victoria, fantastic as always. Victoria Green, Michael Purvis, Colin Martin. Coming up on the show, inflation concerns looming over the Biden administration just ahead of the midterms.
Look, I'm a capitalist, but capitalism without competition is not capitalism. It's exploitation. So I'm going to continue to do everything in my power to work with the Congress to make our capitalist system work better, to provide more competition and lower prices for American consumers.
That's coming up next. This is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty.
I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Truly a strong recovery and opportunity for hardworking women and men all across this great country. America is back to work.
President Biden taking a victory lap. The White House economic advisor Heather Boushey saying it's up to the Fed to tackle rising cost pressures.
We did what we could on the fiscal side to make sure that we had a swift recovery, that we got jobs back, and then it is up to the Federal Reserve to use their toolbox to ensure price stability.
Out of D.C., Bloomberg's Anne-Marie. Hey, Anne-Marie.
Hey, John, we do see the administration wanting to take a little bit of a turn and repackage how they're going to communicate their economic agenda and policies to the public. So the president there was focusing on jobs after that surprise report on Friday. And we're really going to see the administration talk about wage growth, good paying union jobs, the president always likes to talk about. And thirdly, as well, the domestic manufacturing he wants to put into the economy. We got a glimpse of it on Friday, Jonathan, when he talked about making sure they can get parents back to work, especially women, and that the government could potentially do more when it comes to childcare. But Jonathan Keeley, he did not mention Build Back Better, because members of his own party, like Senator Joe Manchin, say that legislation is dead. So it's really going to be a shift in tone to this administration. But what this administration wants to do is address parts of the economy where they think they can expand the productiveness of. Not so much leaning into what Treasury Yellen and her modern supply side theory, but for sure they are trying to find those pockets where they can make a difference in consumers' lives.
AMH, happy birthday down in Washington. That's the last chance I've got today.
Getting too much
That's the
now.
last chance
It's too
I've got.
much.
That's the last chance I've got. Anne-Marie, thank you.
I'm sure
down
you'll
in
call
DC.
me.
We appreciate it. Look at the crude, 91.15 on WTI. Brent at 92.65. We pull back a little bit. Jeff Curry of Goldman Sachs got my attention. He got your attention this morning. This is what he had to say.
I've been doing this 30 years and I've never seen markets like this. This is a molecule crisis. We're out of everything. I don't care if it's oil, gas, coal, copper, alloy, you name it, we're out of it.
Joining us now, Bloomberg's Julian Lee. Julian, what a line from Jeff Curry.
Yeah, you know, I've been doing this as long as Jeff has, and you really do struggle to see anything like this. The time this most reminds me of is 2007 going into 2008. We know where that ended up. It ended up with crude at just shy of $150 a barrel, followed by the most almighty crash.
Asymmetric risk, Julian, that's what I'm thinking about now. Life above 100 is difficult. Historically, it's tough. And I'm just wondering, when you get to these kind of levels, if you've got to bet on crude or on the underlying commodity producers. Is it a bit toppy up here, Julian?
I'm not sure. I mean, I think if you look at the underlying fundamentals, we have relatively strong demand growth still. We're still coming out of the pandemic. There's still a lot of stimulus around. It's perhaps slowly being eased off, but there's a lot of pent-up demand there. And on the supply side, after 2 or 3 years of real underinvestment in new supply, we're seeing the OPEC plus producers beginning to bump up against capacity constraints. We're seeing slower perhaps than expected growth in some of the non-OPEC countries. Eyes are going to be back on the US shale sector without a doubt, and the growth that we see there. But you can see real fundamental tightness here.
Julian Lee of Bloomberg. Julian, great work as always, buddy. The move year to date in the energy names on the S&P, I keep going back to that sector at more than 24% year to date. Just absolutely unreal stuff, with crude at 91 on WTI and Brent at 92.73. Let's get you some sector price action and get across to Kriti Gupta. Hey, Kriti.
Well, good morning, John. You are seeing a little bit of green on the screen, but a lot of it is isolated in big tech. It comes down to that David and Goliath story that you are going to see in markets. Consumer discretionary, information technology, essentially your big tech names leading the way higher. Towards the bottom, you have materials and utilities. Some of that movement in the tech space is also coming from a little bit of that merger Monday. Some questions about who might be a potential candidate to take over Peloton. So you are seeing some of that show up in the price action nevertheless. You are also seeing some of that merger Monday theme in the airlines as well. Frontier Group agreeing to buy Spirit Airlines for $2.9 billion in cash and stock. The deal uniting two ultra-low cost carriers. Now remember, this is coming after months and months of airlines broadly being under pressure. Perhaps this is the moment for them to make a comeback, John.
Is this what Ryanair used to be? Frontier and Spirit? Is that what this is? I've never been on these planes, Kriti. Is that what they are?
Similar story, yeah, essentially.
Like Ryanair back in the day, if you're watching this from Europe, and you all remember what it was like back in the day when you had to run across the tarmac to get a seat because they weren't allocated. Good times. Equities doing okay. Bond yields coming a basis point on twos, just south of 130 on twos right now, 129. A 10-year yield, 192. Yields up a basis point. All I can think about is running across to the plane to go from East Midlands to Bergamo for £15. Coming up, your trading diary from New York City. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
25 minutes in, Nasdaq coming back up 0.9%. Let's call it 1% higher on the S&P, up a third. The small caps, the Russell doing okay, up 0.9%. In the bond market, we settled down. This time in and around 130 on twos. Right now coming in a basis point to 129.64. Looking at the Italian bond market, we back away from the session highs too. Guy Johnson and Katie Lyons will run you through that in just a moment. That's the price action. Here's the trading diary. Looking like this for President Biden, meeting with the German leader, 1:30 Eastern time. Trade balance numbers coming on Tuesday. Wholesale inventories on Wednesday, plus Fed Governor Bowman and Cleveland Fed President Loretta Mester speaking later in the day. Then US CPI, the big one for this week, with initial jobless claims on Thursday, plus tech earnings. Continue with Twitter on deck, and rounding out the week with the University of Michigan Consumer Sentiment Survey. From New York City, welcome back to a brand new trading week. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Hello traders, how are you doing today? I'm going to place order to sell short euro. The price I'm looking to sell 1:14.36. If you decided to trade euro, here is your chance. 1:14.36. The price I'm looking to sell short euro against United States dollar. Okay, the actual price is really close to the price I want to sell. So if you want to trade with me, if you want to copy my trade, please do so and stay with me. As you can see, the position open, short position open for euro, and all of you guys who managed sell short euro, stay with me and I'll speak to you later. I will have to restart the streamer in about 4 or 5 minutes. So look like you will have time and chance to sell short at the high price. Okay, and please restart streamer. Just press F5 or refresh button when streamer will stop and it will restart. Unfortunately, YouTube does not allow me to show you 12 hours continuous stream. So I need to, in 3.5 hours, I'll have to restart the streamer. Okay, guys, I'll speak to you later.